Announcements and reminders. So for the speakers, we actually have available, if you want it, a clip-on mic so you can walk around. If you feel like using that, of course, you got to put it on yourself, I think, or maybe someone can help you. If you're at the table and you're asking a question, use these mics. So speak into the mic so that so our online audience can hear you. And Zoom participants, remember we're going to use the raise hand, or we have been using the raise hand feature, and then towards the very end of this of the second discussant, we'll elevate you to a panelist. Please turn on your video, and you will appear as if you are in the room. Thank you.
Okay. Thanks. So the first session this morning is on the shrinking of the Federal Reserve balance sheet. We have 3 speakers, so we have more of a panel format than a paper format. And the first presentation will be from Arvind Krishnamurthy.
Okay, thank you very much for having me here. I'm going to talk about what we have learned from QE research and how that should affect how we think about how the Fed goes into asset purchases, QE, as well as how it exits from asset purchases, QT. And, there's this famous quote from Ben Bernanke that the problem with QE is it works in practice and it doesn't work in theory. But we've been working on the theory and the data of this for 12 years, and I think we've actually learned quite a bit. And so what I'm going to talk through is what we've learned, to me, what the key things that we've learned from how QE works, and then take you through how I think that should affect the way the Fed uses QE. And centrally, I'm going to criticize the Fed because I don't think that their rules have incorporated what we know about the way in which QE works. Okay, so that's the talk I'm going to give you. So what do we know about QE? We know that QE works quite differently than conventional policy. And there's a couple of different ways that it works quite differently than conventional policy. The first is a point that the impacts are highest in the asset market targeted. Right? So central bank QE, which in the US is mostly meant buying treasuries, buying mortgages, and backstopping the corporate bond market, has the biggest impact on the asset market that's targeted. You can see this both from the US, and I'll take you through some data. You can also see this from Europe as well as experiences around the world. The second thing that really comes out quite clearly from the data is that the impacts are highest during times of financial distress. And I'll show you a little picture on that, but you probably know this as well. And the point is it's dramatically different. One could say the same thing about conventional policy. Right? Easing probably has state-dependent effects, but the state dependence is much more significant when it comes to QE. And then a second point, and this is one I think we've sort of groped towards over the last 12 years, which is that the post-crisis financial system requires a much higher level of reserve balances than it did pre-crisis. So pre-crisis, we were running on $50, $60 billion of central bank reserves. We're running on much higher levels of central bank reserves. There is some uncertainty as to exactly what that right number is. There's been lots of very good work on this. I was talking to Annette about this yesterday, who has a recent paper on this. So there's lots of good work, and the Fed's been after this as well. And it's quite relevant for thinking about particularly QT. So as we're shrinking down, you have to think about what the minimum level is, and it's quite a bit bigger than what it was pre-crisis. Okay, so what I want to do is I want to talk you through point 1 here, and mostly go and talk through lessons that we learned for how we should think about QE rules, my point 3 there. I'm going to say less about point 2. One could spend 15 minutes just talking about point 2 and thinking about the minimum balance, but I'm going to put that aside for today's talk. All right, so let me start with this point about it matters what you buy, and the asset market you buy is the thing that moves the most. So this is a picture from QE event study from the UK, the Bank of England's purchase program for gilts. And I'm going to start with the left panel. This left panel is event day across the event, which is February 11th of 2009. The Bank of England announces that we're going to buy long-term gilts. You see a movement in yields, this black line, which shifts down quite a bit. Now, if you just look at that movement, you'd say, well, you know, that looks kind of like conventional policy in the sense typically when a central bank lowers rates, you see a bigger reaction in short maturities and fading out reactions in long maturities. But you see a significant impact on that day. The panel on the right, I think, really clarifies what's special about QE, which is what you buy is really what moves. And the reason I say that is because on this date, the Bank of England clarifies that what they're buying is gilts in the range from 5 to 25 years. Right? And you can see what happens to the yield curve is you see very big movements in the 5 to 25-year range and smaller movements both under as well as over. Right? So it's very narrowly, and buying 5 to 25-year bonds, that's the thing that really moves. The second thing that you can see from this picture is the gray line. The gray line is the change in the spread between the gilt yields and OIS. Right? So OIS, a benchmark interest rate in the market, which is not the asset that's being targeted in this case. So the Bank of England is buying gilts. And so if you compare the gilt movements to the change in the yield to OIS spread, you see that the yield to OIS spread moves almost as much as the gilts, which is telling you that OIS is not moving that much. So general market interest rates are not moving as much. They're moving a bit. That gap is the movement to OIS rates. The big movement is really substantially in gilts. Right? So you see it in two dimensions. There's this target, both in maturity as well as in the asset purchased. That's a statement about government bond purchases. Annette and I have written quite a bit about the mortgage purchase program, and you basically see the same type of effects. The securities that move when the Fed buys mortgages are particularly mortgage-backed securities, and in fact, you can drill down even more and recognize that what the Fed's buying when it buys mortgages is they're buying TBAs of current coupon mortgages, and then when you look across different mortgage securities, that's the thing that really moves the most. Right? So what I've just talked to you about is asset price movements. There's very nice work that documents that the same thing is happening in asset quantities. And I'll just give you 2 data points. There's a nice paper by Rodninsky and Darmouni, which looks at commercial bank lending in response to these QE events. And in particular, looks at the difference in lending responses when the Fed's buying mortgages to when the Fed's buying treasuries. And given the asset price reaction, you would expect that when the Fed buy mortgages, that should cause the commercial banks to lend more real estate, because that's the price that's really moving. And that's exactly what they find. They find that when the Fed buys mortgages, it drives more real estate lending. When the Fed buys treasuries, it doesn't drive more real estate lending. So that's telling you the price effect is also feeding through to quantities. You see a very similar effect from this other paper, DiMargio, Carmani, and Palmer, which is if it's mortgages, then what you should expect is that MBS purchases should particularly spur conforming mortgages rather than jumbo mortgages, which is what the Fed's buying, and that's exactly what you pick out as well. So both in asset price as well as quantity space, what you buy is what really moves. There's a lot more evidence from this, and I'll write this up. I'm not going to talk about it, from looking at the same types of programs in Europe as well. So you see similar effects when in corporate bond purchases, in a collection of different programs that we have seen in Europe, you see the same type of effects. Okay, next point. This is Google's bond yield during the March 2020 COVID crisis episode, the period of financial market turmoil. And you see that in blue is the yield on Google's bonds. The orange line is the CDS on Google. Okay? So this is sort of a clear example of a market dislocation. Google is an investment-grade company. Its bond yield spikes up dramatically. At the heart of this crisis, this is up by something like 1.5%, with little change in the credit risk attached to Google. You can't see the vertical line. It's exactly here. This is that's the event day when the Fed announces its corporate bond purchase program. And you can see the yields come back down quite dramatically back to normal. So you're having an action by the Fed where basically stepping in to backstop the corporate bond market, which is bringing down corporate bond yields by on the order of 1.5%. And so this is the point I'm making. Conventional policy would have eased. It's also easing here. But you see a much more dramatic reaction with respect to QE policy. And I'm fairly sure that if the Fed had announced here that they're buying corporate bonds, you wouldn't have seen so much of an effect, right? The effect is very dramatic when asset prices are very dislocated. Okay, so let's take those 2 points and let's turn that to thinking about how the Fed runs policy. Okay, so this is kind of a characterization of pulling from speeches and on Fed research and how the Fed, I think, is thinking about policy. And I'm talking about the Fed here, but what I'm saying here, I think, applies to other central banks around the world, too. All right, so the Fed typically talks about policy in terms of how QE impacts the term premium. Right? So, for example, a statement like Q dollars of QE moves 10-year term premium by 20 basis points, coupled with another statement that says an X basis point reduction in the policy rate moves the 10-year rate by 20 basis points. You put those two statements together, and what you're doing is you're putting QE on the same footing as conventional policy. So, for example, those two statements together imply that Q equals X. It gives you a way of sizing QE, right? If I'm sitting here trying to move the policy rate by a certain amount to move the 10-year rate by 20 basis points, I can do that by moving the policy rate. I can also do that by doing QE of a certain amount that gets me the same. Okay, so that's, I think, the kind of the verbal model that the Fed often uses, and it's in fact not just a verbal model. It's the model that the Fed will often use in simulating the impact of QE. Take the FRB US model, move the 10-year rate by 20 basis points, and now I size what the effect is. You can see from what I've just talked about, that's wrong in a couple dimensions. It's wrong in at least one dimension immediately because it tells you, I've told you that if the Fed buys, say, treasuries or mortgages, it might move treasuries or mortgages by 20 basis points, but it's not moving all rates by 20 basis points. Whereas the heart of conventional policy is I move the policy rate and I move all rates by the same amount. So those two things are not the same. They have different characteristics when you think about that. So that can't possibly be right, but it is convenient. It's convenient because it's looking at a world in which you're tying together conventional and unconventional policy and placing them on similar footing. That's convenient because conventional policy is the thing we understand the best. So as a matter of communication of policy, it's sort of convenient to talk about QE in units of conventional policy because it allows me to communicate easier what I'm doing, but it is wrong. Okay? And where I think it can go wrong, for example, is if you tie together conventional and unconventional policy, you're also tying together rules of entry and exit of QE in line with conventional policy. So, for example, the Fed has this policy where it sequences. Taper my asset purchases first, then raise policy rate. That's sort of basically saying, well, my policy rule for conventional policy is inflation up, unemployment, the Taylor rule, and I'm tying QE along with that conventional policy. That's suggestive of a model where those two things look the same or look similar. Very different than what the data I just took you says. So, for example, if I take those two facts that we've learned about what QE works, asset market targeted is the thing that moves the most. The impact is highest during distress times. Just take those two facts and think about what a policy rule might look like. So you might say, well, if the central bank policy has a bigger effect in crisis states than normal states, then what should happen is the central bank, for example, should use its balance sheet, expand its balance sheet more in crisis states than normal. So imagine there's some distress state X. If we're worse than X, we should go in. If we're better than X, we should exit. What is X? X is determined by something like the cost of balance sheet. How big a balance sheet the Fed can run should determine what the cutoff between when you exit and enter. But it's market conditions, in a sense, which should determine whether you should enter and exit. X, and this is coming back to a point I raised at the beginning, should be different than what it was pre-crisis, because we have a steady-state balance sheet that probably means we should be much higher than before, right? But that's about all I can say. So you should expect some type of conditionality policy, and it should be about financial market conditions, not explicitly about inflation and unemployment, which is what the Taylor rule is tying together. Okay, so, and as I said, you know, when we tie together the balance sheet changes with the policy rate, we're implicitly doing something that's different than this. Here's another example of maybe a policy and a perhaps error. So I've told you QE works mostly through narrow channels of the asset market it targeted. Again, very different than conventional policy. It follows then that the central bank should use policy, balance sheet policy, considering the mechanisms in the targeted asset market. Right? So for example, buy mortgages if housing is central to macro dynamics. In contrast, if you ignore that, you might do something that I think was a mistake, which is, for example, the Fed continued its mortgage purchases well past the COVID crisis period of March 2020. And you know, sitting there today, that sure looks like 0.5%, 1% movement in mortgage yields through the Fed's mortgage purchases, which has probably fueled a housing boom that we're probably not so happy about sitting now. So just to conclude, you know, I've just made this point that QE works very differently than conventional policy. The Fed's model seems to be tying these two things together. That's wrong. I think that's clearly wrong from all of the data we've seen. That should very broadly tell us that the policy rules governing QE as well as QT should be quite different than conventional policy. I mentioned this other point in passing, which is that the economy requires much higher levels of reserves than it did pre-crisis, which should also inform when we enter and when we exit. But I don't have a number on this. Okay, thank you.
Thanks, Arvind. The second speaker will be Sydney Ludvigsen.
Okay, well, today I want to talk to you about the stock market's reaction to the Fed's balance sheet normalization plans. And I should say that my comments are based on joint work with Francesco Bianchi and Sai Ma. And, you know, so I'm going to zoom out and take a very macro finance perspective here. And here's what I'd like to do. So the outline is I'll first describe to you the high-frequency event study that we undertook for this talk of the major Fed communications pertaining to its balance sheet normalization plans. I'll call these QT events, right, for short. And we identified 14 QT events. These include both tapering statements from the Federal Reserve and tightening statements on grounds that tapering always comes before tightening. So we lumped these together. These are news events that span May 22nd, 2013 to March 20th, 2019. And they're taken from FOMC press releases, Fed chair press conferences, or Fed chair congressional testimony. And then we look in high-frequency windows that begin 10 minutes before the beginning of this QT communication to the close of the stock market. Then next, what I will do is use a structural model to interpret, make inferences on why the market reacted the way it did. So we're going to use a methodology based on my work with Francesco and Sai, BLM hereafter, where we integrate a high-frequency monetary event study into a mixed-frequency macro finance model and structural estimation. Okay, so let's just look at quickly zoom out and look at the jumps in market variables around QT events. And here I've got for each Fed QT announcement, there's 14 of them, the log change in the observed variable, there's some financial variables here, from 10 minutes before to the end of the stock market trading day, except for these two series here, which are the Bloomberg consensus expected inflation 1 year ahead, consensus expected GDP growth 1 year ahead. These are daily series, so in that case, it's the day before and the day after, but high-frequency evidence on macro expectations. Okay, so what you can see is there's some large jumps in the stock market. The top 5 are labeled with their dates there, and so, you know, some of these are big positive surprises, 2% almost, and others negative, close to negative 2%. There are also some big jumps in financial futures, Fed funds futures markets is what I'm showing you here, quite often into the distance. I'm not going to have much time to say anything about this. We do use this in our estimation, but it's interesting to note that those also jump in these same days in some of these events. By contrast, these QT events, we find, do nothing to change expectations for the broader economy. So inflation and GDP growth, you can see down at the bottom here, don't move at all. These expectations don't seem to move at all, at least according to this signal about them, despite the large movements in financial markets. Now, I should also say that it's not that these expectations don't move around Fed news. They do. We find that they do sometimes in our main paper, but those are not statements that are about QE or QT. Okay. So bottom line, first thing, big jumps in financial markets, virtually no impact on expectations for the broader economy. Now, let's just dissect a couple of these announcements. I don't have time to go through all 14 of them, but just let's take the top 3 in terms of the quantitatively most important ones for the stock market. And so here's a big positive surprise, which came on December 18th, 2013. And, you know, these gray bars, areas indicate the event time window that we use. And so this is a situation where the FOMC released a statement. It was the first statement to say by how much and when tapering would occur. And you can see that, you know, initially there was this little blip downward in the market, and if you look at press reports for that day, they all indicate that that was just because the market saw, oh, tapering is here, oh my gosh, but then realized that the taper was, quote, tiny, right? So smaller than expected, the market rises and then continues to accelerate. As Bernanke in his press conference starts talking about, I want to emphasize that we are going to be data dependent. We could stop the reductions in the pace of purchases if the economy disappoints. We could reduce the pace of purchases somewhat more quickly if the economy is stronger. So this data dependent comment is a theme we see throughout these statements. Markets react very favorably to the sort of, I will say, perceived flexibility in the plans from such comments. Now, then the market continues to rise when Bernanke says, we expect the total balance sheet to be quite large and to be maintained for a long time. Okay. So the mirror image of this is Powell's press conference on December 19, 2013, where, you know, there was an FOMC press release at 2 p.m. It didn't say anything about the balance sheet, so we don't include that in our event window. But, you know, on the whole, the market fell almost 1.9%, and it started going down during the press conference when Powell was, you know, confronted with questions about QT. So at 2:41 p.m., so we came to the view that we would effectively have the balance sheet run off on automatic pilot, and I think that's been a good decision, and I don't see us changing that. Market accelerates downward when more questions about this arise, and he says, if you just run the quantitative easing models in reverse, you would get a pretty small adjustment in economic growth and real outcomes. We don't see the balance sheet runoff as creating serious problems. So this automatic pilot comment is the flip side. It's sort of not received well by the market. Market declines about 1.9%. Okay. And then the last one we can discuss, and these are all sort of representative of the 14 events. May 22nd, 2013, the infamous taper tantrum. Chair Bernanke in testimony, markets are rising until at 10:31 p.m., Bernanke says we could, in the next few meetings, take a step down in our pace of purchases. Then the losses accelerate at 2 p.m. when the FOMC released minutes from a previous meeting saying that a number of officials in the FOMC backed tapering as early as June, which was just a few weeks away. So on the whole, market down 1.7% in those hours. Okay, so the question we wanted to ask is, why is the market reacting the way it's reacting? And so again, we're going to use this BLM approach where we're integrating this high-frequency event study into a mixed-frequency macro-finance model and structural estimation. So let me just explain what this model is. It's a two-agent model with New Keynesian macrodynamics. These agents have heterogeneous beliefs, which turns out to be important for various things I don't have time to go into, but in particular, investors are forward-looking and they can react quickly to news, okay? So including news from the Fed. They own all the equity in this model and they participate in the risk-free nominal bond market. Workers or households, by contrast, have adaptive expectations with, according to our estimates using survey data, lots of inertia in them. And we assume that their expectations are key for the predominating movements of aggregate inflation expectations and aggregate GDP growth expectations. Now, there's a monetary policy rule that's subject to infrequent structural change, structural breaks, so investors will have to form beliefs about that. There's two assets, a stock market and a nominal risk-free bond. There's 6 primitive Gaussian shocks, aggregate demand shock, a monetary policy shock, a trend growth shock, a markup shock, an earnings share shock, and a liquidity premium shock. Now, the first 4 of these are very standard from New Keynesian models. The last 2 are less standard. This earnings share shock is a purely redistributive shock that shifts the share of rewards going between workers and shareholders without affecting the size of those rewards. Liquidity premium shock is, it's basically a time-varying preference for risk-free nominal debt over equity. And then we estimate jumps in investor beliefs about the economic state, about the perceived sources of economic risk, and future regime changes in the monetary policy rule, all in response to Fed announcements. Here I'll apply that to these 14 QT announcements. We do this by mapping numerous forward-looking series at mixed frequencies to their theoretical implications in the model for beliefs, markets, and the economy, and to data, estimating all the parameters and latent states. So let me just quickly show you 2 equations from the model that illustrate the channels of QE or QT transmission in our model and these estimates. And so at the top you see this monetary policy rule. With regime changes, the blue parameters are shifting over time with a discrete valued random variable psi t that we estimate these changes. The first thing I need to be clear about is that monetary policy is summarized by this rule in this model. So there is no explicit Fed buying of long-term treasuries, agency debt, or agency-backed MBS. We're doing that right now, but that's going to have to be for a different paper. However, there are channels through which quantitative interventions will affect the economy in this model, and the first one to think about is what I'll call an inflation expectations channel. So QE or QT would manifest potentially in higher or lower value, higher if it's QE, lower if it's QT, values for this parameter, this pi t psi t, right, which looks like an inflation target. But keep in mind, this is a time-varying parameter, and it may not coincide, in fact, it doesn't often coincide, with the stated long-term inflation objectives of the central bank. So think of this as an implicit time t target that can be manipulated by the central bank to achieve its goals. Now, QE, QT, and for that matter, forward guidance can all affect this parameter and change it because these interventions can, in theory, change inflation expectations and thus real rates, pushing on aggregate demand, even if the nominal rate on the left-hand side, this little I, is unchanged. Okay? Now, in practice, what we find is that because households adjust their inflation expectations very slowly, there's a lot of inertia in those expectations to changes in this implicit target, this channel is going to be quite muted. That's a result that we find here. So this channel is not going, to have much of a role to play. But even if that channel is muted, there are other channels whereby QE or QT news can affect financial markets in this model and in our estimates. The first is there's a risk premium channel. Okay, so if this news coincides with jumps in beliefs about monetary policy regime change, then that will affect the perceived quantity of risk. And if you look at this perceived equity premium, you see these covariance terms. M is the stochastic discount factor. That will change those covariance terms endogenously. Okay, and I'll explain how that works quickly in a minute. There's also, we'll call this the liquidity premium channel. This liquidity premium over there is sort of a catch-all for all the sources of variation in the equity premium that may not be attributable to our endogenous variation in the perceived quantity of risk. These could be driven by a perceived change in the liquidity or safety attributes of risk-free nominal debt, as in Arvind's work with Annette Bissing-Jorgensen, changes in risk aversion, flights to quality, jumps in sentiment, and so on. Then there's something I'll call an information effect channel. If this news coincides with jumps in investor nowcasts of the broader economy, the Fed information effect, or, for lack of a better word, a distributional information effect channel, if these announcements coincide with jumps in investor nowcasts of the share of rewards that will accrue to equity holders. Now, I just want to stress, though, in this model, unless these QT or QE announcements are associated also with a change in the real interest rate, which in this model would have to come through this inflation expectations channel, all of these things will just generate volatility in financial markets with the broader economy completely unaffected. Okay, so now I just want to show you our estimate of the contribution of revisions in investor perceptions about the economic state and about beliefs about future policy changes to jumps in the stock market in these tight windows around these QT events. So we're going to be able to get granular detail on why markets respond to Fed news using this procedure. Really, it could be done for any news, so it's really broadly applicable. But the combination of a filtering algorithm plus structural estimation plus lots of forward-looking data allows us to infer investor updating, not only of the economic state, but also of which shocks they perceive are hitting the economy in real time. And so that's what this is showing you here. So I've just put the top three, in the interest of time, the top three news events for the stock market out of these QT events. And reporting a decomposition of the movements in the S&P 500 in tight windows around these QT events into sources attributable to revisions in the perceived shocks hitting the economy. These are our shocks here. And to jumps in beliefs about the near-term monetary policy regime change. And the triangles show you where the market actually went on that day, which coincides with the model-implied jump in response to QT news. So December 18, 2013, we see the market rose, almost 2%, and that's largely due to the fact that the subjective equity premium fell. And the subjective equity premium fell in this case because the liquidity premium component of that fell. But there was also a role to be played by upward revisions in these tight windows for the investor nowcasts of the earnings share, the share going to equity holders, and an upward revision in aggregate demand nowcasts. The mirror image here is December 19, 2018. Here we see exactly the opposite. The subjective equity premium rose, in large part, again, because the liquidity premium component rose, but now there's also a role for beliefs, which I'll discuss in a second. That's this smaller bar at the bottom. But again, a lower nowcast in this case for the share of rewards going to equity holders also drives down the market. So if you just look at the top events for revisions in investor expectations about monetary policy regime change, the most important is this Powell press conference of December 19, 2018. And what this top panel is showing you is that there is, according to our estimates, a big perceived decline in the probability of a near-term monetary policy regime change within the next year. So what on the bottom panel this shows is we decompose the price payout ratio in the model into the present discounted value of subjectively expected future real interest rates, payout growth, and return premium. And this is showing you that this PD ratio declines, that's the black dot, because subjective return premium increase, and that is in part because of these beliefs shifting. And so what happened with these beliefs is there was a decline in the perceived probability of switching to a more active monetary policy regime, where the Fed would be more actively engaged in stabilizing the real economy. Now, a less active central bank engaged in stabilizing output growth increases expected volatility, and along with it, the perceived quantity of risk, and that drives down the market. That, less activism, is the structural interpretation of Powell's autopilot runoff comment as seen through the lens of this model. Okay, my takeaways. Whether it's tapering or tightening, clearly the stock market dislikes perceived inflexibility in the Fed's balance sheet normalization plans. You know, financial markets are clearly attuned to news about the balance sheet. It clearly matters to financial markets. Subjective equity return premia are big drivers of the stock market around these QT events, with perceptions about the earnings share playing an important secondary role. And that was an interesting nut for us to chew on and to see and hear. We do find it in some other FOMC statements as well, but it really comes out here as well. The open question that we were left with is, you know, and perhaps the Fed to think about is, do these market jumps in response to QT news have any relevance for the broader economy? I mean, there's little, actually no evidence that forecasts a high frequency of inflation or GDP growth change in response to these QT news events. I mean, there are no forecaster tantrums. There's a long literature in asset pricing showing that much of the variation in stock market return premia has negligible correlation with the macroeconomy at any horizon. And remember that these earnings share changes merely redistribute the rewards without affecting the size of the rewards. So by definition, changes in the perceived value of this share concurrently and for forecasts have nothing to do with changing expectations for the broader economy. Okay, so I'll leave it there.
Interesting. Thanks, Sydney. And the third speaker is Jonathan Wright.
Okay, thank you very much. I'd like to thank the organizers for putting me on this panel. The three of us are taking related but quite distinct interpretations to the question. So hopefully whatever you're looking for will be spanned by what we're talking about. So I want to first of all talk about what I think is the likely scale and scope of quantitative tightening. So this is a picture of the Fed balance sheet breaking the liabilities into four pieces: currency, reserves, reverse repo, and other, which is mainly the Treasury account. And it's all scaled by nominal GDP. So we see the financial crisis, a big run-up, a smaller QT, and then the QE during COVID. So the New York Fed put out some projections for QT back in May. And they had reserves going down to 8% of nominal GDP before balance sheet growth resumes, and reverse repo going to 0, and the total of this going to 22% of nominal GDP. So my first starting point is I think QT is likely to be very much less than that. So if you're talking about a 22% of nominal GDP and you do the math, that means you resume balance sheet growth around $5.9 trillion. And that doesn't start until 2025. So my reasons for thinking that the Fed will have a substantially bigger balance sheet than that are, first of all, 8% of GDP reserves. That's very close to where the Fed got into trouble in September 2019. And to have one incident like that is misfortune. To do the same thing twice is carelessness. And you also have this Treasury balance piece, which is not just big, but volatile. And mechanically, when that goes up, that drains reserves. So I think that they're going to want to keep a bigger buffer than 8% of nominal GDP. And the reverse repo piece is important because otherwise you have the concern that you will be paying an interest on reserves that is far above the actual repo rate. So you sort of lose control of the broad configuration of short-term rates. So I don't think they're going to want to set that to 0. And importantly, once you've shrunk the balance sheet, it becomes very hard to do things like reverse repo. You've given up that option. So I'm going to base my remarks on an assumption that it's going to go to something more like 28% of nominal GDP, which would mean that QT would end about the end of next year with a balance sheet of about 7.5 trillion. There's been very little in the way of policymaker direct remarks on the future size of the balance sheet. The one I could find was a comment in a press conference by the Fed chair where he talked about 2 to 2.5 years, which is longer than I think I'm thinking, but still quite a bit shorter than the New York Fed projections. So a feature of this is, at least my assumption, is that QE will never get reversed or even largely reversed. And that's the same as what happened in the wake of the financial crisis. And there may be particular reasons each time why the magnitude of the increase in reserves is bigger than or this balance sheet is bigger than the subsequent runoff. But I think there may also be some more structural reasons why it's easier to go into an increase in the balance sheet than it is to reverse it. Viral Acharya has a paper on that. And moving over to the asset side of the balance sheet, of course, it's MBS and Treasury. Now, the Fed has made clear that absent another extraordinary crisis, that they're going to continue shrinking mortgage-backed securities even after they resume balance sheet growth. Mechanically, that means that once they start increasing the balance sheet, the size of their Treasury holdings has to grow faster than nominal GDP if MBS is to shrink, and their aim is to go back to an all-Treasury balance sheet. And then the last thing is on the maturity of the Fed's balance sheet. So the Fed's convention has been generally to match or at least get close to the weighted average maturity of Treasuries outstanding. And in COVID, they ended up accumulating something with quite a longer maturity than marketable Treasuries. And their policy is first to redeem coupon securities and only then to redeem bills to reach their cap. So that should also tend to reduce the WAM of the SOMA portfolio and increase the maturity of what has to be held by the public. So the scale of QT, the pace is about twice as fast as it was last time. I'm assuming that it will amount to about a $1 trillion decline in treasuries, some shortening of the maturity of those holdings, and then a gradual move out of mortgage-backed securities that continues even after the balance sheet resumes growth. One thing is, I'll come back to this in a minute, that because the MBS that the Treasury holds have a low coupon, refinancing is not really a good idea for holders of those mortgages, and so prepayment speeds are likely to be very slow. So the runoff in MBS is likely to be quite slow, and so direct MBS outright sales are a distinct possibility. Now, let me talk a bit about channels of unconventional monetary policy more broadly, and this relates to things Arvind talked about. Some people like to emphasize broad channels where unconventional monetary policy asset purchasers are going to move the entire configuration of fixed income and move term premia and expected rates. And in this idea, what you buy doesn't matter. It's all fungible. Treasuries, MBS is fungible. Others emphasize narrower effects. You get an impact on what you buy. And there's been, by now, a huge literature of which this is just a tiny subset, which to some degree will say they're both there, but I think emphasizes more the narrow or local effects, that you get a price impact on what you buy. If you want to lower MBS rates, you better buy MBS, not Treasuries. And that's for QE. I think it's reasonable to infer from that that QT might also tend to have somewhat local effects. Now, importantly, QT is not simply the opposite of QE. There are a number of reasons. First of all, QE had signaling implications about what policy was going to be. QT does not. It's just that they want to get the balance sheet back down, but it's not meant to be saying something about future policy. QE includes an implicit promise at times that more will be done if needed. And I think if you're looking at the reactions to some QE announcements, it can only make sense in those terms, that you're announcing this, but the possibility of more down the road. QE is done often in times of disrupted asset markets. QT is not. And QE is done at the zero lower bound. QT is done away from it. And Joe Gagnon, my colleague Olivier Jeanne, have a paper showing that will make a difference and impact their effects. I think that if we're taking the view that QT and QE are two different things, it's very challenging to identify the effects of QT specifically, because there are not many announcements that are about QT specifically, and to the extent they are, I don't think that they're very big surprises. So it's hard to know, but I will propose that the best or the least bad way of trying to get a handle on what QT specifically would do would be to look at the effects of maturity and size of Treasuries outstanding, Treasury issuance in the days prior to the zero lower bound. So the amounts that the public has to absorb of Treasury securities. That's been done. So Greenwood and Vianos have put together data on maturity-weighted debt-to-GDP ratios. So that's taking each maturity bucket, taking the amount of debt in that bucket, scaling it by GDP, weighting by maturity, and adding it up. It's roughly debt-to-GDP times WAM. And so I did an exercise of taking an estimate of the 10-year term premium and regressing it on maturity-weighted debt to GDP on data before the zero lower bound. Greenwood and Vianos did something similar, except they had the 10-year yield on the right-hand side and controlled for the 1-year yield. So when I do that, I get that a 1 unit increase in the maturity-weighted debt to GDP ratio causes the term premium to go up by 33 basis points. Now, an obvious worry with this kind of thing is that Treasury debt managers see a higher term premium and shorten maturity. So a solution to that that's been proposed by a number of people is, okay, instrument by the unweighted, the debt to GDP ratio itself, which is something that the Treasury managers have no control over. And that doesn't seem to change things very much. So by my assumptions, QT is plausibly about a 0.6, 0.7 year increase in maturity-weighted debt-to-GDP ratio. And so that should get you about 20, 25 basis point increase in the term premium. There's a Fed paper by Crawley et al. Who use Forbes to calibrate the effect on the term premium. They get a 50 basis point number, but they're assuming the New York Fed projections. So that's the reason why we're different. We end up actually with just about the same elasticities. So this constitutes what I'd call a slope shock, but a small slope shock, a small shock to the term premium. And in a paper with Jan and Jim, we looked at a VAR to identify the effects of both Fed funds shocks, regular policy shocks, and slope shocks. And we were careful to make sure that this was calibrated to be consistent with a lot of other papers in the literature. So in general, if it's a small shock, it should have a small effect. Specifically, if you took the estimates in that paper, it would imply 1/10 of a percentage point on unemployment and basis points on inflation. There are some caveats I'd make. I haven't talked about MBS sales, and we might worry about Treasury market liquidity as well. So I don't really know why, but Treasury market liquidity has been rather poor recently. So this is a measure of liquidity, the mean absolute pricing error, which has been tending to rise. And QT is not going to improve that and might make it worse. I think this particular measure of liquidity may be a little more alarmist than others would be, but still I put out there that the QT probably won't help Treasury market liquidity. And just finishing up with MBS. So this is the distribution of the SOMA holdings of mortgage-backed securities by coupon. And it's nearly all 2 and 2.5% coupon. So you're not going to want to refinance a mortgage with anything in that range. So the prepayment speeds are likely to be very slow. I don't have my own prepayment model, but I go and look at what Wall Street people come up with, and they say 20 to 25 billion a month. So that's actually below the cap. They're not going to succeed in running down MBS at the pace that they have targeted, or at least set as the cap. Here's a graph of the option-adjusted spread on MBS relative to Treasuries. And in this picture, you absolutely see the effects of QE. Right there and there are the two big QEs that included mortgage-backed securities. The QE that did not include mortgage-backed securities does not have an effect on this. The last QT episode you just don't see it there. So at least the previous QT episode, I think, would have negligible effects on MBS spreads. That doesn't mean it doesn't have an effect on MBS rates, because it's spread over Treasuries, but negligible effects on MBS spreads. And until outright sales actually begin, there's going to be only just about the same pace of payoffs of prepayments as there was last time, because last time they were around 17 trillion, and because of this thing of the options being deeply in the money, it's unlikely until they do outright sales that there'll be more MBS spread effects. So I've talked really here about how much the Fed balance sheet will shrink and what I think the effects of that are. I'll just finish with one brief remark. Another question is, how much should it shrink? There are arguments by Bill Nelson for wanting a much smaller balance sheet. There are financial stability arguments for wanting to keep it big. I'll just end with one remark on it, which is the current system works well in terms of controlling the Fed funds rate and repo rates, the cross-section of interest rates, and doing that with minimal volatility. And it's been a long time since we have used different methods for implementing monetary policy, and a lot has changed in terms of regulation since then. A wise approach is often, if it ain't broke, don't fix it. And so I think for that reason, if for no other, it's not just likely, but also, I think, wise for the Fed to keep a pretty big balance sheet.
Okay. Thank you, Jonathan. As you noted, 3 very different approaches to the question. Before we go out to the group, I wanted to give our panelists some time to comment, because they'll never get the microphone back if we don't give it to them now. So I wanted to maybe start with Arvind and have you can comment in any way you like, but one prompt might be to whether Sydney's evidence made you think differently about your view on the distinction between QT and conventional policy, and we can then give Sydney and Jonathan a chance to weigh in as well.
Okay, thanks, Jan. I actually was going to comment exactly on that. So, Sydney, I don't know if you interpret this the same way I do, but I'm going to give you an interpretation of your results, and it's actually related to Annette's Fed put paper. You have these 2 regimes, which the market is inferring based upon these announcements. That sounds like a signal about the size of the Fed put. That's how I'm interpreting it, which is about how the policy rate will react in some states, whether it's very aggressive or not. That's a signaling effect, not kind of the hydraulic effect of purchases. So we've known from many papers that QE announcements have important effects on the signal about the path of the policy rate. But I think you're telling us additionally that some of these QT announcements have changed the way the market interprets the aggressiveness of the Fed's policy rate reaction function, which sounds like effectively telling you something about the strike of the Fed put or something like that. One comment on Jonathan's presentation, he made this comment, which is something that really jumps out of the data. The Fed seems to go into QE, but comes out very slowly, this ratchet effect that Viral has written about. I'm going to interpret that also partly through this thing of we're tying together QE to policy rates. As long as you're keeping policy rates low, if you're tying it together, you'll just keep the balance sheet high. That's roughly what central banks around the world have done, as opposed to kind of recognizing maybe it's time to get out now because we're sort of done what we need to.
So, you know, it's interesting because, you know, I was thinking of, we do see, especially in that Chair Powell press conference, some evidence of consistent with what you were talking about. You know, one of the things that, you know, I was thinking about during your presentation is that there's, you know, this stuff works most when there's times of distress and there's this state dependence, and your view that, you know, we shouldn't tie together conventional and unconventional policies and think they work the same way. So that's actually consistent with other evidence that we find, and I'm just wondering if, which, you know, I could go into, but it does seem like it's very difficult to replicate accommodative monetary policy at the lower bound with QE. It doesn't quite work the same way. But, you know, there are these reactions in markets, and so I'm wondering if you think that one way of, in terms of channels to the broader economy, what these unconventional policies really do is remove tail risk, whereas the conventional policies push more on the means of the distribution. If that's, you know, I mean, an interpretation of this disconnect.
Yeah, that sounds like the Fed put again. Sort of what I'm going to do in some bad state is being signaled through my announcements.
Yeah, so just one quick comment would be, we've learned a lot about QE from event study type episodes, including things that Sydney was talking about. If we're really thinking that QE and QT are different for various reasons, including that QE might be something about removing tail risk, which QT might not be, we have to be pretty disciplined about saying that we're going to separate whether we have a QE announcement or a QT one. Two of the big announcements that Sydney looked at were about the taper tantrum, which I see more as telling people that QE wasn't lasting indefinitely, not really about balance sheet shrinkage. So it would be great to get real event study evidence on QT that doesn't somehow borrow the inference that it's the opposite of QE, but it's really hard to do that.
Okay, let's go to the floor. I want to start with Mike Kiley.
Hi, thanks. And, you know, a great series of presentations from the panelists. I learned a lot. Maybe just a few observations, mainly on Arvind's presentation. I'll probably mischaracterize what he said somewhat, but I think what he said could be stated as, you know, the Fed has a model or a way of thinking about quantitative easing where it is an extremely good substitute for conventional policy and works through very similar channels by broadly affecting financial conditions. And then that secondarily, that model of how QE works leads to a policy approach with flaws. And I think there's a lot to learn about QE, but I think that if I were to review the work that Federal Reserve researchers, you know, and some at least ex-policymakers have published on quantitative easing, I think that's a mischaracterization of how the Fed approaches quantitative easing. I think that can be seen in a number of ways. So looking at sort of research, if we were to go to the debate on broad versus narrow channels of quantitative easing and look at the series of papers that, you know, Jonathan started to cite or that we all would cite, it would be dominated by Federal Reserve researchers, emphasizing that narrow channels are really important and that the effects are not so broad. That shows up in sort of work directly on sort of announcement effects or on day of intervention effects. I mean, I think an early study is that by Stefania D'Amico and Thomas King. There are many others. And it shows up in sort of effects on broader financial conditions. Unfortunately, I'll just cite like my own work. There are a variety of papers on that. And I think clearly that evidence is that quantitative easing has a less broad effect on financial conditions than conventional policy for sort of equivalent movements in the portions of the yield curve that one might be looking at. I think secondarily, that work directly informs how Federal Reserve simulations are run, and that's across a range of research and policy implications. So, for example, in the FRB-US model, it's the case that one might take a QE effect on the 10-year term premium and work that through. But that does not affect financial conditions in that model the same way as a 10-year term interest rate effect through the federal funds rate, because there are a variety of other interest rates with different maturities at the within the FRB-US model, and those are, in all of the modeling efforts, affected differentially by purchases that are concentrated at the 10-year tenure. And so that's directly in, and it just shows up in the simulations. Quantitative easing is not a perfect substitute for the federal funds rate, and that's incorporated in work on the FRB-US model, in addition to work on sort of dynamic stochastic general equilibrium models, et cetera, where that sort of imperfect substitutability is, explicitly modeled. So there are early papers by Ed Nelson, David Lopez-Salido. Again, I have papers, many other people have papers explicitly emphasizing that QE is not a perfect substitute for the federal funds rate. Now, of course, I've talked all about the researchers, and one could ask, well, do policymakers think that way? And I just can't say. I can say that if I were to go to like Ben Bernanke's recent book, he explicitly cites all of the research I just said on 21st century monetary policy and says, QE is not a perfect substitute. Look, cite this paper, cite, basically every paper I just cited, he points to more or less. And so I do think it's widely appreciated. And as a result, I think the second conclusion that the sort of policy approach is fundamentally flawed, does not follow. I do think it's the case that the Fed, but I think economists in general have a view that we are somewhere between the very broad and the very narrow channels, and that's how policy is conducted. We have a lot to learn on what good QE rules are. If I were to go and think about explicit modeling of QE rules, and again turn to like Ben's book, he cites like a couple papers by a couple of Fed researchers. We don't have enough research on that. But I don't think we don't have enough research on it because people aren't thinking about it in the right way.
Thanks. We're going to go to Bob Hall.
Thanks. So there's two topics here, and they're nicely mixed together. But I think it's really important to understand that on the one hand, there's QE type things where the Fed's job is to put out fires in particular asset markets, for example, the MBS market, and the role of reserves there is simply that's how they're funded, and all these bond purchases. The emergency move is always to purchase bonds, not to sell bonds. There's no emergency that ever needs to be put out by selling bonds, and so that gives this asymmetry that this literature talks a lot about. And then there's the other question, and the one that I've always been interested in, which is, what is the optimal size and how do you operate the monetary system with either ample reserves or traditionally in the U.S. very low reserves. The title of this session is shrinking, so there seems to be management seems to believe that it's obvious that the reserves outstanding are too big now, and we should sell off those assets. And of course, there's a big school, which I belong to, that thinks, no, that's not right. It's actually a great idea to have ample reserves. Milton Friedman told us why, and we should do that. There are some issues that have come up, however. First of all, it's very important to understand how active the Fed is in the repo market, and so reserves now consist of traditional reserves plus the net between the reverse position that the Fed takes. The Fed also is now active on the other side, so you have to get to do the repos, you have to take the net, I believe. But that's still an important tool that doesn't get much attention, but is a big deal now. I think the biggest deal, though, is coordination with the Treasury. And what seems to have happened a lot recently is that the Fed thinks that the federal debt should be funded in the short end of the market, the overnight market in particular, whereas the Treasury likes to borrow long. And that's just a way of enriching the dealers. And the coordination with the Treasury would be a very good thing, and maybe a restoration of the tradition that they don't fight each other in terms of the maturity of reserves. So anyway, I think we've learned of that, and especially again going back to the repo, there's some people who think that the entire funding of the Fed's balance sheet should occur in the repo market, and that would be an interesting development.
Thanks. We have more speakers than minutes left, so if we can focus the remarks, we'll be able to hear from everybody. Jason Furman?
I guess I just wanted to ask directly if any of this has relevance for the type of macro inflation unemployment questions. Jonathan, I took 25 basis points to mean sort of no, we should just think about managing the financial system and not having things chaotic. Sydney, I took that from yours. I think, Arvind, I took this from you as well. So this is really sort of a very important financial debate, and if the Fed wants to deal with the macroeconomy, it should just keep changing the Fed funds rate and not worry about any of this stuff.
And we have Kristen Forbes online. Kristen, can you accept the panelist invite, and we'll see if we can see you?
She might be able to talk right now.
Yeah, can you
There we
hear
go.
me?
Yes, go ahead.
Okay, sorry, I can't find the invite, but I'll just ask my question even if you can't see me. So really interesting analysis and discussions, most of it focused on QE or QT in the US on US variables, which makes sense. That's more tangible, more manageable. There's also been a bunch of papers looking at how QE in the US affected other countries. Maybe we'll get more into that later in the day with Maury's paper. But I was wondering for this set of panelists, if there's any evidence on how QT or QE in other countries affected the US. There obviously isn't any evidence on how QT in other countries affected the US because other countries haven't done it yet, so we don't know yet. But I was hoping you might speculate, if you would dare, or talk about if you thought the unwinding of balance sheets in other countries could have some effect on the US or how QT goes in the US. Because we really are looking at a different situation now than in 2017 to 2019. In 2017 to 2019, it was just the US unwinding. Now we have a number of countries unwinding their balance sheets. The UK, Canada, New Zealand, others may soon follow. So do you think we should be looking at this more in terms of a general equilibrium for the global economy, global demand and supply for bonds, so that the fact other countries are doing QT might have some effects on the US or affect the process in the US?
Jonathan Pingle?
Yeah, thanks. The panelists all seem very calm about this, with the exception of Jonathan noting that we don't want to live through September 2019 again, because injecting volatility in these markets where trillions of dollars roll and fund the financial system is difficult. But one of the things that didn't come up is the speed with which we're shrinking the balance sheet this time. And I was curious if the panelists had any concerns over that. There are adjustments, and I think this is why Jonathan's estimate of reserve balances needed is high relative to other estimates, is because of the adjustments that need to be made with bank deposit rates, the RRP falling. But if we look back to 2019, we had reserve scarcity in the spring and then substantial repo market distress in September. By more than doubling the pace of reserve draining, I mean, you've substantially compressed the time between warning signs and stress. And I was curious if the panelists were concerned at all.
Don Cohn?
2013 taper tantrum was also primarily a monetary policy signal. They thought the Fed would tighten sooner than they had previously thought it would tighten. And I think, unfortunately, the experience of the taper tantrum put a lot of inertia into the Fed's response and decision when to taper and how fast to taper and how to announce it in 2021. But I think the world has changed. There are the dots. There are other ways of signaling future monetary policy that are being much more actively used now. So I think the Fed could have been quicker, more active, and less worried about a taper tantrum in 2021, replicating 2013. The second point is that I think the equilibrium level reserves and the volatility getting there depend importantly on the regulatory environment. So the level of reserves depends partly on the demand for reserves depends partly on these liquidity regulations, the composition of liquidity, how the supervisors look at it. I think this was evident in the lessons learned from September 2019, daylight overdrafts and things like that. So the Fed can do a bunch of things to lower the demand for reserves if it's careful about how it structures its regulations, its financial stability regulations, and in that, the liquidity of the market depends a lot on the willingness of dealers to make markets. And there you have the problem of the leverage ratio constraining dealers. So it was encouraging that Michael Barr yesterday or the day before at Brookings said the leverage ratio, the SLR, was under consideration. They were going to look at it. So they need to figure out ways of making the Treasury market more liquid. They have put a backstop facility in place, right? The standing repo facility, which might also enable them to take reserves or test lower levels without a lot of market, minimizing the market disruption as a consequence.
Joe Buglio.
Thank you. I was hoping that the panelists could help me understand something that's puzzling me now. And I'll start with a private fact that in my 17 and plus years career in the private sector, I've written approximately a bazillion emails on QE, QT, and almost none on Treasury refinancings, tax surprises, and things like that. And so then what's puzzling me now is there still appears to be ongoing angst about the QT ramp-up, even though it strikes me as a done deal. And the response of like, yeah, but Treasury is also seeing like an exceedingly large amount of surprisingly tax inflows has almost no interest.
Jonathan Parker.
So this is a reaction to several of the panelists. It seems to me that conventional policy may also have disproportionate effects on the asset purchased. Certainly sort of the federal funds rate versus deposit rates, that has a big swing, and potentially also federal funds rate versus other short-term assets, and sort of the open market operations assets that are actually purchased versus very similar other assets that sit around them. If not, it's presumably because the market has developed the infrastructure and volume and institutions to smooth out those small price deviations across similar assets. And so what makes QE special is not the particular assets that are purchased, but more the frequency and the type of policy that surrounds the purchase of those assets, whether the institutional structure is such that it smooths out the small price deviations that the sudden large purchases create. And so there's nothing particularly special, I think, in the conduct of monetary policy that has to work purely in short duration assets, that monetary policy the Fed could steer the economy largely by intervening between reserves and long-term assets. It would just be a different choice. And so the question then is, what seems then particular about QE, QT, or QE is that it happens in surprise in an area of the market that the financial market isn't used to having a lot of Fed action in. And then QT would be different, as Jonathan suggests, because it's a slow and more expected movement, which allows the market to then prepare for and trade to eliminate sort of the price impacts. And then one little footnote for Sydney. I think what is interesting in thinking about your finding about the types, about the price response to inflexibility is that I would think, or flexibility, is that I would think it'd be interesting to try and distinguish two types of flexibility. Discretion, like we leave the window open to do whatever we want, from rule-based or data-driven flexibility. So inflexibility can be inflexibility that's data-driven, like we commit to do the following rules. That's a very useful sort of inflexibility the market might like, rather than inflexibility as you describe it, as we have a certain volume we're going to do no matter what the data says.
Hannah?
I had a question for Jonathan. Jonathan argued quite persuasively, I thought, that the effects of QT would be quite small. You mentioned a number like 25 basis points. But then I struggled to reconcile that with what we've actually seen in the bond market. If you look at the 10-year TIPS yield, let's take inflation off the table and just look at real yields, they've actually, in a matter of months, gone up by maybe 150 basis points. So then the question is, what accounts for that? Of course, other things have kicked in. The Fed has started conventional monetary policy as well, but the Fed funds rate is not a unit root process. At the 10-year horizon, moving the short rate around right now should have a tiny effect, really, in a standard expectations hypothesis sense. So then something else that's quite dramatic must have happened. That's my question.
Ben Friedman is online. Let's see if we can get him on. Hi, Ben. There you are. Oh.
Thank you. I have a general observation and then a specific suggestion. The general observation is that I'm always puzzled when people say that these quantitative actions are something that work in practice but not in theory, that we don't have a theory for it. Standard Markowitz-Tobin asset pricing theory makes pretty clear that when assets have different risk properties, then changing the supply or demand of one relative to the other is going to change the market clearing vector of relative returns. And so we can always assume that, say, 2-year and 10-year treasuries have identical risk properties, but that's an empirical assumption. And we can always assume that the public and the central bank holding the securities doesn't make any difference. We know assumptions that would make that true, but those are rather specialized assumptions, and so it doesn't seem to me to warrant the notion that we have no theory for this. The more specific observation is that as I listened to the presentations, which I thought were all first-rate quality, it seems to me the implication is that the central bank should be prepared to use quantitative tightening deliberately in specific circumstances. And I'll give one example and then stop. We all remember that in the years leading up to the 2008 financial crisis, everybody understood that the housing market was overheated. We all knew that. And some people called for the Federal Reserve to tighten as early as 2005-06. And the standard story was that raising interest rates was too blunt an instrument to attack an overheating in one sector of the economy. That was the standard instrument. Monetary policy was a blunt instrument. Well, if the central bank is sitting on a portfolio of a couple of $1 trillion worth of mortgage-backed securities and could have deliberately sold a bunch of those securities, that would have widened out the spread between mortgage lending rates and treasury rates, and that wouldn't have been a blunt instrument at all. That would have been a very useful corrective to what we all recognized was an overheated housing market. And I'm surprised that people don't talk about the implication that the central bank ought to keep on the balance sheet some healthy supply of, say, mortgage backs in order to sell in just those circumstances. Thank you.
Thanks, Ben. I'm going to have one last comment from Annette Vissing-Jorgensen.
Thank you. So from where I'm sitting, there's two key issues to think about in terms of quantitative tightening. The first one is what Jonathan touched on, which is how much quantitative tightening is going to be possible. I just wanted to flag that I guess I should refer to myself as a senior Federal Reserve official, has re-estimated the amount of feasible runoff, and the result is posted on my Google site page. It comes to a number higher than the New York Fed number, but I should say these are my own views. The second issue with respect to quantitative tightening, I think, is essentially is to what extent it should be used actively or passively. So are we doing quantitative tightening just to reduce the balance sheet so we're ready for the next disasters, we can do more QE? Or should we try to use it actively like we are with the short rate? And I think, they're both, first the Bank of England, and the Fed have come out and said that the short rate is the main tool for tightening, and QT is not really used actively. I do think that there hasn't been a lot of debate, and I want to flag this as something we need more research on, in the sense that if inflation is, quite high, is the appropriate response to say, look, we're only going to use our most well-understood, perhaps most effective tool, or do we need to throw all our tools in the hat? And there are sort of conflicting intuitions you could have about this. You could say, well, if QT doesn't work that well, maybe we shouldn't do it. But if it works to some extent, maybe we need to do even more because it's not as effective, as we would have liked. And so I think theoretically it's not obvious, and we need a lot more thought. And I don't want people to sort of all just say, well, QT doesn't have real effects, and therefore we shouldn't use it actively. To the extent it has some real effect, and inflation is really bad, we may want to use it actively. And I'm not really taking a stand, I'm just calling for a bigger debate about what the right answer is that I think is missing.
Thanks, Annette. Good place to stop. We'll have our break now and come back at 10 o'clock.
It's just really, I thought it was really great to see this generational shift and them really stepping up and doing it well. Okay, everybody, let's get going. Let's get going. Okay, so the next paper is on a topic that I think we've all experienced. Steve Davis, you're up. When we get the mic working, I guess.
You want? Okay, thanks. It's great to be here and have a chance to present this paper. It has many authors. Chevet and Pablo are sitting over here to my right. Nick, Jose, and Matthias are online. So, as Jim just alluded to, there's been an extraordinary change in the way we work and where we work since the onset of the pandemic. And I want to start with just an observations on that for the US, where I can piece together a long time series. So the data before the pandemic here are from 2 government sources. The data since May 2020 is from our US Survey of Working Arrangements and Attitudes that Nick, Jose, and I run. And what you see there is just this extraordinary abrupt increase in work from home. These are the percent of full paid days done at home. It was on a slow upward trend before, and then we had this massive increase, and now it's settled down at something in between. In case you're skeptical about survey data, at least our survey data, let me show you the relationship between the survey data, which is the parent to the survey I'll be talking about extensively today, and Google workplace mobility data. And again, this is the US. And you can see they tell similar stories, especially since late 2020. Okay? Now, these developments prompt a number of questions. It's obvious that the pandemic was somehow the catalyst for all this, but exactly what the mechanisms through which the pandemic catalyzed this abrupt, huge, and lasting impact on working arrangements is less clear, so I want to speak to that. Second question is, how have societal experiences during the pandemic, the number of deaths, the stringency of government restrictions on commercial and social activity, influenced future work from home levels? What does all this portend for workers? And how might this big shift to remote work affect the pace of innovation and the fortunes of cities? And I'll be a little bit more speculative on the last one because we have less in the way of evidence on that. So to shed some light on these questions, what we do is we field a new survey of working arrangements in 27 countries around the world. We've got about 36,000 observations accumulated over 2 waves, one in mid-2021 and one in early 2022. We implement the survey by contracting with a professional survey research firm, Respondee. Throughout the analysis, I'll do 2 quality control restrictions on the data. I'll drop people who finish the survey implausibly quickly, and we drop people who fail an attention check question. Those two things together drop about 1/5 of the raw data. The survey is pretty short by design. It's about median response time is about 8 minutes. We don't want people to suffer survey fatigue. There's one big weakness in our survey, and that is that we oversample highly educated people relative to the workforce in each individual country. And in almost all of the developing economies and in many of the advanced economies, that oversampling is pretty extreme. So we aren't going to try to create representative samples of our target population, which, by the way, is full-time workers 20 to 64 in each of these countries. Instead, what we'll do is I'll show you conditional country-level means that control for age, sex, education, industry, and survey wave, or timing of the wave. And I'll kind of use the regression coefficients on country-level fixed effects and benchmark everything to the raw US mean. So when I make country-level comparisons, I'm showing you these conditional country-level means. which go at least some way to adjust for differences in the composition of the sample across countries. So first point I want to make is that working from home is now a global phenomenon among well-educated people. So what you see here, these conditional mean days per week worked from home in countries around the world, and again, this is as of mid-2021 and early 2022. The average in our sample, the average of the conditional means is 1.5 days a week. And you can see there's quite a bit of cross-country variation here. And again, I've conditioned out on the things that I talked about earlier. Now, looking forward, one of the things we do in our surveys, we ask the question that I posed here. After 2022, after COVID's over in 2022 and later, how often is your employer planning for you to work from home? Okay, and you can see the response options there. If they say never or about once or twice a month, or if they say my employer hasn't discussed the matter with me, then we code it as a 0. And then we obviously code 1 to 5 days a week, and in the obvious way. And people who don't have an employer are dropped from this particular analysis. So here we see planned working from home from days are about 0.7 days per week, and again with a lot of variation across countries. Okay, so when we get to the trying to explain that, there's something interesting to explain. Now, what accounts for the lasting uptake in work from home as the pandemic has receded, at least in terms of deaths and hospitalizations and so on? There's evidence in the literature, all of which is discussed in the paper, that several things are in play. What I'm going to focus on in my remarks here today is the first item on this list, and I'll maybe talk a little bit about 5 if I don't run out of time. So here's our 3-part explanation for what happened. There was mass experimentation as a result of people's desires to avoid contagion fears and to abide by government restrictions on commercial and social activity. Because the pandemic lasted and recurred for many months, that experimentation happened extensively for workers and firms in countries around the world. And it was also it happened at the same time, which meant there were certain things you could learn that you couldn't learn otherwise. As a consequence of learning about where remote work might work, where it didn't work, for whom it worked, for what types of tasks and so on, there was a tremendous flow of new information. That new information led to a revision in priors about what kinds of tasks, what kinds of jobs, what kinds of people, what kinds of organizations were well suited for remote work and what weren't. And it's that revision of priors that then led to a reoptimization of working arrangements as the pandemic receded and going into the future indefinitely. So that's what I want to focus on as a mechanism. And we get at that with 2 sets of questions. First, we ask people, anybody who had experience working mainly from home during the pandemic, how did working from home work out for you relative to your pre-pandemic expectations, okay, in terms of productivity? So these are self-assessed productivities. Here's the distribution. There's 2 noteworthy features of that distribution. It's highly dispersed. Okay, so if you think about it, if you start from a situation where very few people are working remotely and you get highly dispersed surprises, the people who got no surprise or negative surprises will continue not working remotely once they have the opportunity to go back to the office or back to the factory or whatever. Those who got positive surprises, though, will change their behavior in the direction of more remote work. Okay? But in addition to the dispersion, you can also see that these surprises, these self-assessed productivity surprises, are biased to the upside. Okay, so people, according to these data, were overly negative about how productive you could be in work from home mode. Now, this is a feature across. So is the dispersion point, but I don't show it here. This is true across almost all the countries in our sample. Taiwan's a bit of an outlier. By the way, HE means the G-SWAY sample is highly skewed towards highly educated people relative to the actual workforce population in that country. So these are big numbers. You know, they average about 7%. Now, the obvious question here is whether we should put any weight on self-assessed productivity while you're working from home. Okay? And again, remember, this is self-assessed productivity relative to your expectations. for working in that mode before the pandemic. So what we do, and this is both a form of validation, but also get this key mechanism, is we also ask people, well, I told you about the question before, what is your employer planning for you to do? So what I'm showing you this picture is the relationship on the horizontal scale between these productivity surprises and what your employer plans for you to do after the pandemic is over on the vertical scale. So this is exploiting the within-country variation across persons. And you can see that there's a very strong, in the sense of highly correlated, relationship here, but also the slope is big. Okay, you can see that on the vertical scale. It's going from roughly 0.5 to 1.8 days per week over the span of the distribution. This pattern holds very strongly within all 27 countries in our sample. And we see this as an indication that the revision of priors, the new flow of information, the revision of priors, is leading to changes in planned behavior after the pandemic's over. Okay? So that, we think, was a big part of what happened. It's not the full story. I alluded to other elements of what happened. Now, there's also a relationship in the data between the duration and the strictness of government lockdowns during the pandemic and what employers say they plan to do with respect to the extent of work from home after the pandemic. Okay? The key column I want to draw your attention to here is column 3, where the outcome variable is planned work from home days per week after the pandemic's over. Things are the regressors here, which are this cumulative lockdown stringency measure that takes into account shelter-in-place orders, business closure orders, school closure orders, and the like, and then a measure of the severity of the pandemic itself in terms of its health consequences, which surprisingly doesn't show up here. But what does show up is countries that have longer, stricter lockdowns, so that seems to have a persistent effect on the extent of working from home that will prevail in the future. Now this picture, unlike the previous one, is relying on cross-country variation for identification. So it's got, there's more room for omitted factors to kind of drive this in ways that might affect your interpretation. Now, getting on to what it means for workers, the basic story is people like it a lot. They like to work from home a lot. That's true on average. There's tremendous dispersion in this. There's also a very systematic structure in preferences around work from home that holds up in essentially all the countries, or almost all the countries in the sample. I will summarize that rather than show you the regressions. First, women prefer working from home more than men, and otherwise similar men. The differential willingness to pay is about 1%. Second, people with children, both men and women and equally strong, have stronger desires to work from home part of the week. Those with longer commutes, not surprisingly, and people with more education. To get an illustration of how much all this matters, take a comparison between two hypothetical persons. A married woman with a graduate degree, children under 14, and a 45-minute commute to the office. And a single man, college educated, who lives 5 minutes away from the office. The difference in their willingness to pay for the option to work from home 2 or 3 days a week is almost 6% of pay. Okay, that's a big effect, and the implication is people are going to sort over working arrangements now that they have the opportunity to do so, and they're also going to sort across employers to find the one that offers the kind of working arrangements that they like. Okay, implications. What does it all mean? First, I've already made this point. There are large direct benefits associated with the shift to work from home. The most obvious comes from the savings in commute time, which in our sample is more than an hour a day for the people in our sample. And these are people who are on this margin where they can work from home part of the time. There's more flexibility in time management, greater personal autonomy. I don't have much time to talk about those. I think those are big deals as well. It's not just commuting time. Not everyone benefits. Okay, I'll let you read the bullet points. I want to use my last minute here to talk about the challenges for cities. So the paper is largely positive about the work from home phenomenon, as you've probably already gleaned from my remarks. Where we see real reasons for worry are challenges for cities. And there's two basic things to recognize. First, the shift to work from home itself is a negative fiscal shock for cities that had organized themselves around large flows of inward commuters and a dense concentration of economic activity in a small space. The other point, maybe less obvious and potentially more important for how things will unfold in the future, though, is that the elasticity of the local tax base with respect to the performance of city governance and the quality of local amenities, both those that are provided through the government, but those that are just naturally endowed, that elasticity is larger than it used to be. And as a consequence, there are both stronger incentives for political leaders to take steps that are economically sound, but there's also greater possibilities for a downward spiral in urban fortunes, because if cities don't deal with their problems with their schools, with crime, with taxes that are high relative to the value of local public goods, it's now easier for people to either leave as residents or to not commute into the city as much. That shrinks the local tax base further, which puts more fiscal strain on the city and can then further degrade the quality of local public goods. So that, I think, is a serious concern. I see I'm out of time, so I'm going to stop. Thanks.
Thanks, Steve. The first discussant is Catherine Abraham.
Do you want this, Catherine? Okay. Catherine's not going to use this.
Thank you. That members of this research team have written over the past couple of years. I really credit this group with recognizing early on the potentially important effects that the pandemic could have on the way that work is organized. And while my comments are going to focus on places where I have questions and reservations about some of the data and the conclusions that we can draw from the data, I want to start by saying I've really learned a lot from this work. So, let's see, sorry, which is the? Oh, it did advance. It was just a little slow. Okay. So, my takeaways from this paper are really three things. One, that while work from home was pretty rare prior to the pandemic, it has grown a lot. One of the most interesting results in the paper from my perspective was this finding that it especially grew in countries that had very strict lockdowns that forced employers to experiment with work from home effectively. A second takeaway from the paper is the author's conclusion that work from home has worked out well where it's been adopted, that workers value it a lot. They present some evidence about, for some people, productivity effects being positive. And they conclude that work from home is likely to persist and grow. I want to talk about three things. One is the data, and I think there are some reasons to be cautious about the conclusion, what the data seem to be telling us. I want to speculate a little bit about what might have happened with work from home if we hadn't had a pandemic. And then I want to talk about what the ceiling on work from home is likely to look like, and some reasons to think that it may not be as high as the paper seems to suggest. So let me start with the data. One obvious reason to be cautious about drawing conclusions from these data is that, as Steve said, the sample isn't representative. I went to look at the documentation from their survey provider as to how they pulled their samples, and it was really not very informative. We do know that the sample is very skewed towards highly educated people. And I think there's also a risk, as with any of these online panel surveys, that the people who choose to participate in the survey aren't going to be similar to others even with the same observable characteristics. They might be people who are more likely to be working from home. And then I think there's some potential biases associated with the questions themselves that are separate from these sample issues. So let me just try to lay out the things I'm concerned about there. I'm not really worried about the answers that people give to just straightforward factual questions. I think those are probably fine. I do worry about the answers to questions where people are asked to respond to a hypothetical. You know, how much are you going to want to work from home when the pandemic is over? Or how likely would you be to quit or look for a new job if your employer told you that you had to come back to the office? And so I'm a little concerned that the answers to those questions, you'll overstate things to some extent. The second thing that I'm concerned about is the responses to questions that require people to do some evaluation, where it's not a straightforward factual question. And maybe the best example is this question about the productivity surprises, where people were asked to say how much higher their productivity was with work from home than they had anticipated. I'll be honest, I wouldn't know how to answer that question. To evaluate my productivity. And I think when people are asked that kind of question, they partly look to the response options for clues about the answer. One possible bias here is the well-known bias of primacy bias. When you're given a bunch of options in a written survey, there's a clear tendency for people to pick the first answer. I think there's a potential issue with social desirability bias. You don't really want to say that you haven't been very productive, so that might skew you towards the answers at the top of this list. And then I think there are effects potentially of the options that people are offered, the categories that people are offered on the answers that they give. The classic study on this is an early study by a set of psychologists. They, in their experiment, asked people how much time they spent on average watching television. And some of them got one set of response options, and some of them got a different set of response options. And it really made a difference to what they said about how much television they watched. The people who got the response options that ended at 2.5 hours or more said, about 16% of them said they spent more than that amount of time. But when the options were different, more than a third said they spent that amount of time. So I worry a little bit about the effect of the response options on the answers that people are giving to these questions. And again, that leads me to be concerned that the answers might overstate what the productivity surprises really were. So then I went to look at, given these questions about the survey data, I went to look for other evidence that I could use to corroborate the responses. The finding that people are spending a lot of time working from home seems consistent with other data. The Household Pulse survey, which may have some of the same problems with representativeness, find that about half of people teleworked at home at least one day during the prior 7 days. There's a survey that the BLS did of businesses, and a lot of them had increased their reliance on telework. So this 1.5 work from home days, the magnitude may not be quite right, but there's clearly a lot of this going on. In terms of whether employers plan to continue offering work from home, the current work from home in the survey in the US was about 1.6 days. Planned work from home after the pandemic was about half that. That's very consistent with what employers say about their plans to continue telework. It's harder to get evidence on the value to workers of this. Workers in the survey said they would give up about 5% of their pay to be able to work from home, and that seems consistent with some experimental evidence, though that evidence is limited. I'm a little skeptical that 26% of workers really would quit or look for a new job if they were told that they couldn't work from home anymore, but there is evidence that in experimental settings where people were either assigned to work from home or not work from home, that there were somewhat higher quit rates for the not work from home group. And then, actually, I have the wrong number in here. I think it should have been 6.7% average productivity surprise, but regardless. We know relatively little, actually, I think, about effects of working from home on productivity. The best evidence we have comes from call center workers who are doing very individual work. There's a new study that looks at engineers. I have some reasons to be a little skeptical of those findings. But again, qualitatively, these findings seem plausible. So I want to turn to a different question, which is, what would we expect to have happened to work from home if we hadn't had a pandemic? And I think it may be helpful to ground these findings in the literature on the diffusion of technological innovation. So there's a very large literature about that. It's common in that literature to find evidence of sort of S-shaped adoption curves. I've included a figure here from the classic paper by Zvi Grilikis on adoption of hybrid corn, near and dear to my heart since I spent my summers in Iowa as a teenager detasseling for hybrid corn producers. The S-shaped pattern would be even more striking if Grilikis hadn't started his data at the point when 10% of acreage was already planted in hybrid corn and then going from there. So what you see is slow initial growth, a takeoff period, and then some leveling off at a ceiling. I pulled together some somewhat different data than Steve did on what was happening to hybrid work from home prior to the pandemic. I looked at data from the Survey of Income and Program Participation, and then data from the American Time Use Survey module on work arrangements. What I see in these dots is evidence of maybe some indication that the share of people who worked from home exclusively at least one day per week was starting to take off. What would have happened without the pandemic, I don't know. It is clear that the pandemic really accelerated this process. It forced experimentation by a lot of employers. It encouraged the development, as the authors say, of new tools that make work from home work better. It maybe helped to change norms. But I do think that to the extent that work from home really has the benefits for workers and firms that I think the authors believe that they do, that we might have gotten there anyway. I don't know how quickly. So let me turn in my last minute or so to how we should think about work from home. And there's obviously a lot, pros on the one hand, cons on the other hand, and as Steve articulated very nicely, that's going to vary across workers and work settings. The pros are less time getting ready for work, less time commuting, greater schedule flexibility. You could maybe add some other things on that side of the ledger. The things that I worry about as cons are, if you're not going into the office as regularly, if you're not seeing your coworkers in person, I think it's going to be harder for you to develop professional working relationships, and I see that really as an issue for people who are new to the workplace. I think there's also potentially for workers increased difficulty of separating home and work, something that I suspect all of us who work at home a lot have a difficulty with. The thing that strikes me in looking at these pros and cons, though, is that I think the pros tend to be things that are really visible sort of immediately. If I'm a worker, I can see, yeah, it's great that I don't have to commute. The things that are cons may take longer to become apparent. And so I'm not sure how in the long run people are going to evaluate this. Just as a data point there is data in the US parent for this GSWA survey that looks at how people have changed their desired days of working from home over time, and there is some evidence that has fallen over time, which might be consistent with my speculation. What about firm performance? There's reasons to think that firms might like work from home. I've listed some of those on the left. On the other hand, there may be there may be cons, and some of those would include the loss of opportunity for informal exchanges of information, the work from home being less conducive to collaboration. And as with workers, I think there's some sense in which the pros are things that are going to be immediately obvious, and the cons are things that may take more time to be appreciated. So I guess my conclusion is it's less clear to me that we're going to end up at this high ceiling that I think the authors are envisioning in terms of the level of work from home that makes sense. Thanks very much.
Thanks, Catherine. The second discussant is Ed Glazer.
Thank you, Jim. Is this working, the mic, or no? Let me see if, testing. The light is on. Okay, I think it is working. I'm grateful to the. I'm grateful to the organizers for including me in this discussion, and I'm grateful to Steve and his tremendous co-authors for putting together an amazing set of data about working from home around the world. And it's great to have a sense about how things are happening. The samples may not be representative, and yet they're still extremely interesting. So I'm going to talk about three things, one of which is similar to what Catherine just said in terms of what does the data actually mean. I will then say a little bit about what this does for firm productivity, although I think mostly that's an issue that is largely unrelated to public policy, as firms can presumably figure this out more or less. And I'll have some reasons why they might not totally. But then I'll talk more about the larger implications of work from home for the neighbors, for other firms, and of course for cities, since that's what I do. Okay. Before we get to the data, why weren't we working from home more before COVID? Indeed, as Catherine just alluded, in fact, all of us were, right? Every single one of us had a hybrid lifestyle beforehand. I mean, everyone who took work home. What we weren't doing was Zooming, right? So what has changed is sort of a particular type of work has migrated in. It's less clear how revolutionary that is, but it is, I think, I'm with Catherine in the sense that it's more of an evolutionary step than a total shock. I find the Davis et al. Sort of theory behind this, that experimentation generated a tremendous flow of new information about WFH, shifted perceptions about its practicality, created experimentation, lots of investment, and then they re-optimized. I think that sounds rather compelling to me. That in fact we had this big shock, we adjusted to it, we learned a whole bunch of new things, and so we're much more comfortable Zooming than we were beforehand. There's probably a little bit in the Natalia Emanuel and Emma Harrington hypothesis that, in fact, one of the reasons why we didn't have hiring for remote jobs ex ante is that if you said you only wanted to go remote, it was a negative signal about your commitment to the firm. And they actually have fairly good data that workers who apply for remote jobs in the pre-pandemic era were, in fact, less productive when they were hired. And in fact, that sort of disappeared a little bit. That signaling, that maybe unfortunate signaling equilibrium disappeared during COVID. In some sense, I want to sort of connect this hypothesis with the sort of broader theme that times of stress often lead to large-scale technological innovation, right? I mean, World War II, the Cold War, these were periods of sort of massive technological change. Why should a global pandemic be any different, right? Now, what do we learn from this data? Certainly, I believe that the data tells us that work from home is a real phenomenon, right? Lots of people are doing it, and lots of people in India or Turkey are also doing it. What you learn from their statistical correction is that Indians or Brazilians who look like Americans are kind of doing it. You don't learn anything about what the representative Brazilian or the representative Indian is, but that doesn't make it less interesting. You learn that there is substantial demand of workers for work from home. I certainly have no question that that's the case. As someone who's trying to retain workers who want to work from home, I see that on a daily basis. And we know that this demand for work from home is stronger for people with children of either gender and stronger for women, and the demand for work from home rises unsurprisingly with commute length. I accept all those points, but I'm not sure about what this tells us about work from home globally. And I created my own pseudo work from home measure using Google mobility data, which just takes the change in workplace visits That's in a percentage term, and then I'm going to multiply that essentially by 5 days to get you the number of days that suggests. And as you can see, there are a bunch of countries where their data and the Google data look exactly the same. That's actually the 45-degree line. That's not actually the fitted line. So if you're on the 45-degree line, you're fitting it. So Sweden, it's exactly right. Egypt, Brazil, India, they bear nothing resembling with each other, right? And the straight-out demographic education thing can explain it. And there's a lot of also places and like Korea, Serbia, Malaysia, most of Asia is sort of pretty far off as well, in part because those places experience much less of a health shock during COVID-19, and so much less of a workplace shock. If you just restrict it to the higher human capital cities, and this is actually the fitted line, they do much better. And there you can see the numbers are closer, and it sort of more or less looks like it's relatively representative for these places. One of the things that I think is most important about work from home is just how strong a complement it is with education, right? At the height of working from home due to the pandemic, which was May 2020, 68.9% of Americans with advanced degrees were working from home, 5% of high school graduates were working from home. This is an enormously elite phenomenon, and one of the things you should all worry about if you look forward to a beneficial world in which we all work from home is that what the heck is going to happen to people who don't have, degrees from MIT? Right? Because they're not doing it, and they're not actually living next to the people with degrees from MIT either. And so the possibility for them to work in the great urban service occupations, the 32 million Americans who worked in leisure, hospitality, and retail trade prior to the pandemic, right? What's going to happen to their futures? And you see this also and there are many factors behind this. This just shows across metropolitan areas the relationship between the share of the population with a college degree and the COVID death rate across metro areas. There are many things related to this, right? Generally ill health in less educated areas, but some part of it was the difficulty in switching to remote work during the early months of the pandemic in less educated places. So this really was a period in which education was enormously protective against dying, and less educated areas not so. We've already discussed a bunch about the mismatch between their education levels and the education levels in the real world. So an astounding 78% of their Indian respondents have graduate degrees. In the Barron Lee data, 7.3% of Indians between 25 and 64 even have tertiary education, right? So this is just a totally different sample. Now, pivoting, what does work from home mean for productivity and well-being within the firm? This is sort of my pre-model for thinking about this. Along the x-axis, we have how much time you're spending at work. As you spend more time at work, your marginal product at work goes down. And this is holding the total amount of work constant. Just, the other thing is your productivity at home. That's going up as you spend more time at work because you're spending less time at home working. And so you come to a point in which the difference in productivity, that's this blue line, is equal to the utility value of working from home, the personal value, the non-productive value. And then, of course, you get to that's the optimal level. If we have a shift up in the productivity at work, then you're going to see more time working at home, unsurprisingly. What's that going to do to overall productivity? That's actually unclear because you have two effects. One of which is you have more productivity at home. The second of which is you've shifted to the less productive way of working, right? So you can't tell overall what that does to GDP within the firm, but it's all kind of optimal, and we probably shouldn't worry very much about it. There are variations, however, on this theme. So the Nick Bloom et al. Hypothesis of 2015 was that for some jobs and for some people, working from home is actually more productive than going to work. This is, of course, would not have been natural for me, as I would have expected that if it was more productive to work from home, the firms would have already been doing this and would have figured this out. But he seems to have found this in a Chinese setting. Another variation which is related to Catherine's comments about the sort of dynamic longer-term effects. There's the learning by seeing hypothesis. This hypothesis that is above all associated with Alfred Marshall, who wrote that in dense clusters the mysteries of the trade become no mystery, but are as it were in the air. And it's this fact that just younger workers who aren't there don't learn. Right? We now have a certain amount of evidence to support this, including the original Bloom et al. Paper, the Emanuel and Harrington paper, which is that the probability of being promoted if you go remote drops by over 50%, okay, in both papers. So there really are fairly substantial dynamic losses associated with not being there. This is the Emanuel and Harrington thing. The blue lines and those pink lines on the bottom just show the lower probabilities of being promoted from the remote jobs. We also have some interesting work that came from the Microsoft team even though they tended to find that static productivity of programmers was unchanged, they found things that looked like they could have dynamic effects. I'll just read you from the abstract. Our results show that firm-wide remote work caused the collaboration network of workers to become more static and siloed, with fewer bridges between disparate parts. Furthermore, there was a decrease in synchronous communication and an increase in asynchronous communication. Together, these effects may make it harder for employees to acquire and share new information across the network. Again, it's a hypothesis more than any sort of a clear fact. And yet it's still something sort of to think about. The last fact I'll give is from, this is actually a Brookings thing, from Jose Ramon Morazaria and Carlos Daboin. This just shows the change in new hires for remotable jobs and non-remotable jobs when the pandemic hit. So these jobs over here are non-remotable. Blue is postings, red is employment. And in the early months of the pandemic, both of them drop down, and then they recover more or less in lockstep. These are jobs that could be done remotely. Actual employment stays steady. New hires craters. And it stays down. So even if the computer programmers were just as productive, Burning Glass's new postings for programmers were down by over 40% between the beginning of 2020 and the end of 2020, and they stayed down, right? They stayed down almost for another year. So people were not willing to onboard new workers for these remotable jobs, which again suggests that something about the learning channel had been turned off during this time period. Is this actually a public policy problem? Well, you can certainly come up with stories. So if work from home is associated with less innovation, and if some of these innovations create benefits outside of the firm, then that would be a loss. Channeling my inner Becker 64, right? If a lot of the learning is general human capital and the younger workers are unable to compensate the firm for that human capital, there could be a market failure here. But I don't think any of this stuff is measurable or clear enough that I would want any public policies to actually respond to it. It's sort of a hypothesis relative to anything that is clear. My larger concerns relate to other firms, especially the ones that don't work from home. So in the wealthy world, right, so if we take the demand for hybrid work as being given, in the wealthy world, I would have thought that in the successful cities, this would lead to a change in prices more than a change in quantities, meaning that markets where commercial rents were sky high before 2020 will become cheaper, right? But those offices will presumably still fill up. Now, I also would have said this about commercial space and the rise of e-commerce, and it's taking a long time for a lot of stores to remain to get filled again. But my belief in fundamentals of markets still continues. Poorer cities in the rich world, the Buffalos, the Clevelands, the places where commercial rents were close to the margins of survival for landlords ex ante, those ones you could really see large-scale vacancies. Those vacancies could spiral. And even in the wealthy worlds, so let's say you're going to continue with the offices in downtown New York being filled, they may still be empty on Monday and Friday. That's not a problem for the commercial landlords, but it is still a problem for the urban service industries that cater to them. It still is a 40% drop in the presence of people who are around. In the poor world, most workers will remain tethered to their physical environment. Knowledge workers may get richer. So I think it's entirely possible that the Zoom thing is a big plus for knowledge workers in Bangalore. I can't figure out what this does actually to local workers. What will happen to manufacturing in these places and whether or not new factories will employ poor people. And just give you two counter effects. So the decline in business travel to the poor world may well hurt manufacturing and other FDI. Right, we know from Philippe Campante's work in the pre-period that, in fact, airplane connections were a big deal in terms of directing FDI. That may go down in increased prevalence on increased reliance on Zoom. On the other hand, it may just be easier to invest without those travels thanks to Zoom, and so you may get more. I don't know, but it's something to watch, and that will be actually more relevant for the average Indian worker than work from home in Bangalore factories will be. This is just a sample of marketed rents pre-pandemic. These are all the high end. These places, prices will go down and quantities will remain relatively unchanged, at least if Economics 101 continues to work. These places are the places where you should expect to see the potential for sort of large-scale vacancies, the places that are on the edge already. The larger political risks that I see, again, this echoes things that were said earlier, right? Talent has never been more mobile, and yet cities have an urge to address long-standing inequities. This feels like a replay of the 1970s to me, when container ships and highways had made it easier for the rich and for businesses to flee the old cities of the Northeast and the Midwest, and at the same time, those cities were trying to address things that were long-standing grievances. The problem is, if you try to run a local welfare state, the rich just get out, and that's indeed exactly what was the setting for New York's near bankruptcy of the mid-1970s. I did a little bit of measuring of urban winners and losers between the end of 2019 and the end of 2021. And I'll just show you what seems to have happened. I used 4 different indices of how cities are doing, employment growth and earnings growth, both from the QCEW, and permit growth and Case-Shiller real price indices growth. Once again, skills were predictive of wage growth. You had sort of surreal wage growth in places like San Francisco and San Jose, according to the QCEW. And employment, once again, employment growth loaded on January temperature. As we know, there's no variable that better predicts metropolitan area growth in the 20th century than January temperature, and it still seems to be the largest single predictor of employment growth during the pandemic. The one exception, of course, is, and long has been, New Orleans, which is in a class always by itself. To me, when I look at these 50 things, I see a non-effect of COVID on urban trends. It seems like it's hypercharging it, not that it's changing it. The move to the Sun Belt, skilled cities getting richer, these are long-standing trends. The variables may have also shifted labor supplies, which seems to have shifted back over this time period. So let me just show you, this is our list. If you just take a simple average of these 4 things, what the z-scores of these 4 things, Austin, Texas clearly leads the list. I mean, Austin had 38% real price growth over this time period, 10% wage growth, 5% employment growth, and a 58.5% increase in housing permit growth. By the way, these 2 facts, the first and the last, are sort of not compatible with equilibrium in the long run. Phoenix, right, Atlanta, Dallas, and Austin all had unbelievable both permit growth and price growth. We've seen this before, and Phoenix permitted as many homes in 2021 as it did in 2005. That did not end well. Okay, there's of these, right? Overwhelmingly, the top ones are in the Sun Belt. They're in the Sun Belt because the Sun Belt has actually seen both employment growth and home price growth. You have a couple of sort of consumer cities in here that are not exactly in the Sun Belt, so Salt Lake City, for example. And then you have the sort of most functional Midwestern cities like Indianapolis and Columbia that are down here. The one city that doesn't belong here is Philadelphia, PA, and that's because it had a surreal increase in housing permits to the end of the year because of a tax break they gave to developers. So we left it on there because it's what the data said, but it's nonsense. It belongs in the other half of the list. In terms of the bottom list, to a certain extent, these are familiar things, right? So the numbers from sort of 17, which is Buffalo, down through Chicago, these are sort of accepted areas. However, there are a couple of things which are unusual relative to the normal sort of winners and losers from urban change. The big cities did particularly poorly. Chicago and New York did much worse during this time period than they would have during the last 40 years. That's sort of an unusual thing and clearly suggests the sort of adverse impact of COVID on big city life. Houston really does not belong on this. But Houston functioned the way a Sunbelt city is supposed to function, which is it stayed affordable, it did not see large housing price increases, and its permits didn't go up that much because they permitted a gazillion, to use Joe's phrase, a bazillion, I think is the right, a bazillion permits beforehand, and they permit a bazillion permits afterwards, so there's no percentage change in the number of permits. So Houston is still moving along, and it is what it is. So to me, at least, I see this as being a speeding up of trends, but not something that is shockingly different. So I think work from home is real. I think it's a bigger deal in the wealthy world than it is in the poor world. I think that it's likely to be, productivity enhancing within firms, but it could have sort of larger effects, particularly in lower amenity areas. And for many, at least American cities, the largest issue is going to be that the competition for talent has just gotten hotter, that it's become easier to relocate things. And those cities that fail to deal with things like their crime problems are likely to pay a significant price for that, as they did during the 1970s and 1980s. So I will end there.
Okay. Thanks, Ed. Questions? So, John, about?
Hi, thanks. And thank you for that very rapid-fire move through a lot of data. I asked this question at Solly of one of your co-authors on just the American data, and I want to ask it again here, not so much because I think it's a problem with the paper, but because I think you have an opportunity to do the profession a lot of good. You have been contracting with survey organizations that do not subscribe to the APOR Transparency Initiative. And that has made it difficult for us to learn about the workings of the surveys that you're running. Virtually every major organization that you've heard of in the U.S. subscribes to that initiative, and all of the major statistical agencies, which aren't allowed to officially subscribe, have essentially copied its requirements into their own standards. These are not standards per se, they are meta-standards. You will say something about sample recruitment, something about response rates, and there's a bunch of standardized definitions that by joining the initiative you agree to use, and that allows comparability across the different vendors and across the different surveys. And it's incredibly useful for things that are in their experimental phase. We learned a lot about the Household Pulse Survey at the Census Bureau and about the Business Pulse Survey, not because we subscribed to the Transparency Initiative, but because we had already de facto published all of the things you needed to do that. And research teams could go in and assess the methods used for, the most important things here are the methods used for non-response corrections and for attempting to make the samples comparable across the different observation units. So I think if you were to insist on APOR transparency-like behavior from your contractors, it would basically be a big boon to the research community, because it would be easier to understand how they're working. So I just wanted to make a pitch for that.
Thanks, Bob. Gordon?
How does this work? It's on your own. Okay. First of all, I wanted to reinforce Catherine's very nice point that the pros of working from home are immediate and the cons are long run. Ed is the great expert on downtown commercial real estate, but I wanted to point out how long and drawn out the adjustment is going to be, because, of course, leases last for many years, and as these leases come up for renewal, one firm after another will opt to release in a much smaller footprint, causing a collapse of commercial office construction, particularly in the older big cities, and a devastating effect on surrounding service businesses. The main thing I wanted to talk about, though, is productivity of working from home. I wanted to reinforce Catherine's comment about the ambiguity of asking survey respondents, how productive are you compared to what you expected? What they expected, of course, is highly ambiguous and gives us very little information. It is particularly confounded by the difficulty of knowing how long they're working. Nick Bloom and Steve Davis, in an earlier paper, came up with a number, something like 2/3 of time previously spent commuting was now spent at work. That means that the productivity answer may really reflect how much output they're doing over the total week. A mix of actually higher productivity per hour and more hours of work in time they previously were commuting. So this is really ambiguous to try to get at this by survey methods. A more direct method, which we have employed, is to construct quarterly productivity data from the national accounts and the BLS for 17 industries, of which 12 are in the service sector, and we divide those between service sector industries where people primarily are working at home, finance, information among them, and service industries where most people are working in direct contact with their customers, leisure, hospitality, retail, wholesale. And we find extremely striking results, and we can break this down by quarter. We find that for the work from home service industries, in 2020, productivity went up at an annual rate of 3%. And then in the 5 quarters of 2021 and 22, it went up even faster at an annual rate of 4%. And the contact services decreased in productivity at an annual rate of about 2% in both those time periods. So in the aggregate data by industry, we have something that reinforces the survey evidence on people's perception of their productivity, but without the measurement ambiguity inherent in those surveys.
Elaine Buckberger.
Thank you. So, great discussion, great paper. Let me make a few points. So first, Catherine makes the point that what people say in surveys may not represent what they're actually willing to do. And perhaps on surveys, people are either complaining or bragging. But I think we need to keep in mind that what they'll actually do and even what they'll say may vary over the cycle. And as we discussed yesterday, we're in this incredibly tight labor market where at any level of education, you have ample jobs. Workers may be more willing to come in person or make other adjustments from wherever they are now, as the labor market softens somewhat. Secondly, if not just work for home, actually the flexibility issue is not just an issue for white-collar workers. And as someone who works in manufacturing, there is a lot of evidence that even those people who actually work in person with their hands in a plant want more flexibility. And that's a challenge to the industry, and there's excellent work by the Manufacturing Institute jointly with Deloitte on that. To John's point about survey quality and survey issues, there are survey providers who actually vary how options come up to avoid bias in responses, and NABE, the National Association for Business Economics, does all of our elections that way, so that I, as someone whose last name starts with a B, am not advantaged by someone whose last name starts with a Z in the election. And last, on productivity, everything in person did have productivity losses early in the pandemic because you needed to do all this cleaning. So between shifts, we had time set aside for cleaning when our lines did not run. Thank you.
Okay, let's go online. Rick Mishkin.
Yeah, I think Catherine raised this important point that one of the biggest concerns about productivity for these remote workers is that they're not going to collaborate as much and there'll be less innovation. But I'd like to point out that I think that you can be much more optimistic about this and be optimistic in the way the authors of the paper are. Because one of the key things that adaptation that's going to occur is to figure out how to actually increase collaboration and innovation when everybody doesn't come into work every day. And in fact, we live in a sector that really has done that, because I've been working most of my time from home since the beginning of my career. And indeed, what we do in academia is we frequently coordinate so that we have all our sort of meetings and workshops and seminars and so forth, all on the same day or the same 2 days of the week. And actually, as a result, we still get a lot of this collaboration and innovation, which is key to our sector. But on the other hand, we still have the advantages of a lot of work, a lot of flexibility. So I think that we're going to see a lot of innovation that's going to be occurring in the remote working sector, to figure out how to actually increase collaboration by coordinating the days of the week that people are actually on site, off sites, and so forth and so on. So I think that this concern about collaboration and innovation may be less of a problem when we actually see innovation to actually accommodate this remote working.
Sten van Niverberg.
Thanks so much. Right here. So Steve, a great paper, great presentation. I've learned a lot from your work over the last couple of years. So I think this focus that Ed also placed on looking at firm productivity is an interesting perspective. And I think we can see this kind of indirectly by looking at office markets. If we look in the last couple of years, the tenants have been voting with their feet, with their dollars. The number of actively signed leases, basically newly signed leases, has fallen from something like 300 million per year to 100 million per year. The drop is really breathtaking. And like Bob Gordon said, this is a train wreck in slow motion. because there's so many people who haven't made these active space decisions yet. Only about 35% of leases that were active as of the end of 2019 have actually come up for renewal in the last couple of years. I also want to echo your point at the end about the fiscal implications of this, which I think is very important. Property tax revenues from office are very important for cities like New York and San Francisco, and that could potentially kind of lead to underfunding of mass transit. We're seeing that in New York very clearly, underfunding of all kinds of other local public amenities. And so the question is, what are the incentives of the local decision makers to do something about it, and does that create some sort of race to the bottom where maybe it's in their best interest to force people back to the office to kind of fix these local negative externalities, but if working from home actually increases overall productivity, that might go against the overall, the good of social welfare. So these two could be in conflict with each other.
Dustin Wilfors.
I'm sort of struck at how many of the discussant comments were of the view that there's all bad news to come on this stuff, so I just wanted to be cheerful about something, which was, of course, this has been a big boom to inclusivity. This conference used to be a hot ticket to be allowed in, and now you can sit in your lounge chair at home and hello to all those who are doing that, and it's much more accessible. The same is true of the NVR, and how much this goes to other workplaces is an open question, but obviously it helps parents and the like. The other thing I wanted to raise was I wanted to commit the sin of moving from micro to macro, because I wonder how we can be confident that we understand any of our macro indicators right now. This is the biggest shift in sort of well-being between, worker well-being between getting cash pay versus a shock to amenities that I've seen in my lifetime. That real wages aren't rising probably isn't that surprising in an era when many workers are getting 2 hours a day back from their employers. When we worry about inflation, we're worrying a lot about productivity. Productivity, as calculated by the BEA, as I understand it, is time at desk. Productivity, as it matters for living standards, is time away from, time wearing fancy clothes. And we've managed to make it now where you can produce 8 hours of time at desk. It used to take 10 hours. It now takes 8 hours. That's a 25% productivity shock right there. I don't know, and these things are as widespread as Steve said. I don't know how we can know at all what's going on with nominal wages, real wages, or productivity, which makes everything kind of hard.
Carolyn Hawksby.
First, thank you for this paper. It's a great paper, highly informative, and very good discussions as well. So I have 3 comments. The first one is about the question that everyone is a little bothered by, which is relative to your pre-pandemic expectations. What do you think your productivity was like? I think that's a very difficult question to answer, partly because of the relative to your pre-pandemic expectations. And it's not clear that people had very well-defined expectations, and they may have even thought, I'll be really productive at home, but there's stigma associated with working at home. So maybe I think it's about the same as my I think it's the expectations part that's hard. I think I would ask a more straightforward question, which is how many hours did you spend working, including hours that you might have spent previously commuting, so just a straight-up hours question. By the way, I think you can learn a lot from surveys, so I have no doubt about that. And then ask a productivity per hour question. So it's how many hours, what's your productivity per hour afterwards versus before when you were mainly working in the office. Then I don't know that this is possible to ask in a really good way, but there's a big difference between saying everyone has the same day a week off. We're all taking Wednesdays off, we're all taking Thursdays off, versus we're distributing ourselves, we're all taking one day off, but we're distributing ourselves. Because the notion that you need 5 days a week in order to do spontaneous collaboration is, in my opinion, foolish, right? Because actually you need some time away from that worker who keeps popping into your office and disturbing you when you're trying to finish a project. And you can collaborate with that other worker the other 4 days a week or the other 3 days a week. You do not need to constantly be in one another's offices chatting. There's not a water cooler talk in offices. And when I talk to people who run offices, they say, we agreed that everyone was taking Friday off. We agreed that everyone was taking Thursday off or something like that. They don't tend to spread it unless they're talking about the receptionists or something like that, where they want them there every day a week. And finally, moving to the sort of urban or cities questions, it's pretty clear that even if we all take 1 day off a week, the office space is not going to be reduced that much, especially if you want people to coordinate on what days they're going to be in. It's not like because we aren't in on Saturday, we don't have to rent the same office footprint. But it is clear that, service work is going to go down in the cities, as has been discussed. But also residential real estate and gentrification, you would think, would be affected. Because if we're all commuting 1 less day a week or 2 fewer days a week, all of a sudden that home that's further away seems more appealing. So residential real estate may be quite differentially affected than office real estate. And finally, stores that are in downtown areas or in cities you would think would be affected not only because of more online shopping, to which people became very accustomed, but also because you have 1 more day or 1.5 more days to shop nearer your home and not try to coordinate it with going into work.
John Halterwinger.
So again, great discussion. I wanted to talk a little bit about some coincident changes in the structure of the economy that I think are broadly consistent with this paper and the idea that this may persist. And I've been looking particularly at applications for new businesses, which has surged dramatically in the pandemic, and they surged in 2020, have remained very high in 2021 and in 2022. And what's particularly interesting is the spatial pattern, and particularly the spatial pattern within cities. So this is not just a between city story, but within cities. So pre-pandemic, if you looked at the growth rate of new business applications, Manhattan, New York County was a place where that was very high. But if you look at this surge during the pandemic, actually Manhattan has been very low within the New York metropolitan area. Actually, it's the surrounding counties where you're seeing an enormous surge in applications for new businesses. And we're beginning to see, actually out of the same QCW data that Ed talked about, if you take that down to the county level within the CBSA, we're beginning to see net entry rates and business formation rates match that. So I think we are seeing changes not only between cities, but within cities, and again, away from some of those key downtown areas.
Jonathan Wright.
I wonder if anyone's looked at how work from home and productivity varies by whether the type of job is something where output can be very directly and uncontroversially measured at high frequency, like how many calls you get in a call center, versus something where it's just hard to just say day by day what output has been.
Admirably brief. Jason Furman?
When I've talked to CEOs, heads of government agencies, small business heads, advocacy groups in DC, they have a wide range of opinion on work from home that ranges from hating it to detesting it. I have not seen a larger disconnect between sort of what I hear out there and what I see in sort of your research and other type of research, and I try to bridge that. It could be they don't see the same productivity gains, could be that they don't see the same willingness to take compensating differential pay cuts, could be a temporary thing, that people are willing to take pay cuts over time, they can't take it right away, so it'll all work out. It could be that some of the evidence to Jonathan's is studying things that are very well measured. The very well measurable things are precisely the things where you think work from home might work the best, losing the long-term effects. I wonder if you can't extrapolate fully from the COVID period. On June 25th, 2020, there was really nothing to do. Everything was closed that day. The only thing to do was to watch BPEA. Today, if you're not interested in the next paper, you can go to the National Gallery because that's now open. So I just, I'm sort of torn, and I'd like to understand why it is the heads of most organizations seem to feel differently, and it could be that they're all wrong and behind the times.
Betsy Stevenson?
Yeah, thank you. So first, actually, I'll start by reinforcing Justin's point about inclusivity. This conference is the first week of school and clashes with curriculum night. There's a reason I'm not there in person. And this Zoom option means I can participate. But my main comment was to think about the levels in this paper versus differences across groups. A lot of the discussants and people have pointed to how much should we trust the survey data, and I am skeptical about the estimates as levels myself. My suggestion before I heard Bob Gordon was to compare your productivity estimates to the recent paper by Fernald and Lee that was presented at Jackson Hole. I do think giving yourself a sense of do our magnitudes match those estimates or Bob Gordon's estimates would be a useful exercise. But I think that the finding that people with the biggest productivity surprises are the most likely to keep working from home seems correct, and I believe those differences, and I think that's a terrific finding that points to the importance of a learning shock that occurred here and speaks against that strong Glaser intuition that businesses would already been doing it if it'd be more productive. I think it points to the importance of business learning, and I really want to just applaud that finding. Similarly, I don't know how much I should make of your estimates of the willingness to pay in terms of the magnitudes, but I think that the differences across groups are really important. And even if the levels might not be exactly right, I think those differences point to who is going to be willing to give up more and who's going to be willing to give up less. And I think there's a lot we need to do to think about that in terms of how workers are going to sort across communities, across jobs, and what that might mean, for the gender wage differential, for instance, and sort of other social aspects that we care about. And so I just wanted to make sure that we're separating skepticism on levels, which may be more warranted than skepticism on differentials, which I think this paper is doing a better job capturing. Thank you.
Gerald Cohen.
So appreciate the paper and the comments. I guess I had two questions. One was, we've talked a lot, or people have thought a lot about outsourcing, as in your move, people working from Boise, or living in Boise, but working in San Francisco. But this raises the question of, is this going to facilitate a trend to more international outsourcing? So people working in Bangalore for San Francisco companies. The second question, and this is somewhat related, goes to how we're measuring these things. So from the CES, I wonder how many people are reporting, they're working for a San Francisco company, but again, are living in Boise or Bangalore. And so I guess whoever here is from the BLS, is that being thought about? I would imagine that the household survey would incorporate that, but we don't know where those people work. So just a question for the statistical agencies, if we can actually think about that.
Okay, authors.
No. Thanks for all the great comments, Catherine in particular. How much time do I have, Jim?
Not much.
Not much.
I mean,
Okay,
technically 1 minute, but
Okay, I'll be two. Okay. First, to Jason, you should get out and talk to more people. There is a large set of business people who detest and hate working from home, as you say, but there's also a lot of heterogeneity there. Two pieces of evidence on this. If you look at Burning Glass data on job postings and whether the new job postings allow for remote work, there's been a steady and rather dramatic upward trend in that from the summer of 2020 to the summer of 2022, which strongly suggests that the shift to work from home is becoming entrenched, even as obviously COVID deaths have diminished. So we have a new paper that's not yet in circulation on that. Second, if you look at our sway data, what you see is that the resistance on employers, which was extremely strong early in the pandemic, has gradually eroded, and employer plans have been basically, for what work from home levels would be after the pandemic, have been drifting up since late 2020. Caroline and Justin raised a lot of points. I'm sympathetic to most of what you said. We've actually written about most of what you say in one way or another, so if anybody in the audience wants to hear follow up to those, send me an email message. I'll send you papers. They're scattered across many papers, but I'm quite sympathetic. I want to push back. There's some of the comments reflected a misconception. This paper doesn't advance any claims about productivity. Some of our other work does. The reason to ask about productivity relative to expectations is to get at a mechanism. Okay, that is very hard to do in other ways, and it's the learning mechanism, the learning reoptimization mechanism. So I just want to make it clear on the kind of the measurement issues. Think about how we used the productivity surprise data. We used it in a relationship to employer plans. Okay, we are well aware that you might not want to take the data at face value, but we're looking at a covariance here. The fact that that shows up so strongly, that the worker's assessment of their productivity surprise correlates so strongly with the employer's plan for what that worker will do, suggests that there is in fact a lot of information in those productivity surprises. Now, a couple more last things about measurement. I think Catherine's point about primacy bias is a good one. However, I do want to note if primacy bias is present in that key relationship between productivity surprises and planned work from home days, it attenuates the relationship I showed you, given the response orderings we had to the two questions. We have begun investigating primacy bias in our other survey, the SWAY. We find, I'd say, pretty mild evidence that it's present. We take that point, we are moving towards a more aggressive randomization of response options. On the social desirability bias issue that she raised, all I would say is look at our survey instrument. I don't think you get much of a clue that we're trying to tilt the questions one way or another, but they're out there. You can form your own judgments on that. Last thing I will say, all of the SWAY data, and more than 100,000 observations now at the micro level back to 2020, you can access as a researcher on our wfhresearch.com website. All of the data that I made use of today will be available on that website, we think, by next week. We tried to get it ready for this conference. We didn't have to. So there's a rich, if you find anything interesting about our data, you're more than welcome to have at it, and we're happy to take suggestions like those from Caroline about what kinds of questions we should be asking. Okay, thanks.
Okay, thanks very much. See you at 11:30. Okay, welcome back for the last paper. So lest we forget about this, let me remind you that we have buffet lunch after this, and also the spring conference is March 30th and March 31st. So let's just get started. And Hanan, you're going to start with the presentation. So let's get started with the final paper.
All right, thanks, Jim. It's been truly an honor to be here. So with Maury, we just want to share a little bit about our paper on the global dollar cycle. So just to put things in perspective, next year, 2023, will be the 50th anniversary to the start of the floating exchange rate regime as we know it. So as a result, the world economy is subject to synchronized asset prices, capital inflows and outflows, as well as leverage. So we call this a global financial cycle. Within this, the dollar exchange rate is a key correlate. And as we will show, it is closely associated with measures of global risk appetite, financial condition on top of the usual suspect, like the U.S. monetary policy. Because of the unique role played by the dollar in global financial system and trade, we think it's useful to also characterize a global dollar cycle. Serious agreement with this. So fluctuation of the dollar certainly have global impact, and we want to characterize this global dollar cycle. A case in point is that since the first half of 2021, we have entered a persistent appreciation phase of the U.S. dollar. And based on our analysis, we want to say that we might expect a slowdown in global economic activity, especially relevant for emerging markets and developing economies. What this paper does is to start by setting out an overview by documenting some key financial market development since the end of the Bretton Woods. And in particular, we focus on documenting correlations of the dollar exchange rate with key global economics and financial variables, such as trade, growth, investment, and asset prices. Then we zoom into emerging markets. We want to ask, what is the relationship between dollar appreciation and emerging market outcomes in macro aggregates, prices, and financial market activity? And the answer we get is a uniform contractionary impact. But the contractionary impact is sort of qualified by a sense of state dependency. We show that countries with appropriate policy regimes and relatively less direct exposure to the dollar through balance sheets may be able to cushion some of the impact of the appreciation shocks. The second half of the paper focuses on factors that drive the global dollar cycle. So we especially highlight the impact of, for instance, long-term interest rates and the dollar liquidity premium on top of the usual suspect, like the short-term interest rate, through a set of theory-consistent exchange rate regressions. And also we want to highlight that one particular measure of U.S. credit market sentiment, called the excess bond premium, is a consistently strong correlate of the dollar across those specifications, showing support to the idea that risk aversion and market sentiment is actually a very important correlates of the dollar. And finally, in our paper, we touch briefly upon the current phase of dollar cycle. And we argue that the persistent inflation environment in the U.S., coupled with a global trend towards market fragmentation, may pose some challenge to the U.S. dollar's global role as reserve currency and other key currency in other areas of the global economic system. We want to start by showing you this simple graph of the development of international financial markets since 1973. So the green line and the yellow line here shows the aggregate current account and capital account surpluses and deficits of countries, broadly divided into 4 groups. As you can see, across the board, global imbalance is rising. In principle, countries in deficit could finance the deficit using the same amount of financial inflows. And by the same token, countries with a current account surplus could dispose of their surplus into the same amount of financial outflows to the rest of the world. But in fact, if you see the blue lines and the red lines here, you can see that the two-way capital inflows and outflows in terms of sizes largely dwarfs the size of the current account surplus and deficits. So the explosion in international financial transactions since the end of the Bretton Woods seems to indicate that perturbations to global market, especially global financial market conditions, could have long-lasting impact both in terms of global financial market and also on the real side. So here, as an illustration, we just show that dollar appreciation is globally contractionary and deflationary. In particular, the fact that international financial markets are typically intermediate in terms of the dollars is a sign that the dollar's impact is also going to be very important here. So as an illustration, here we plot the correlation between dollar appreciation rate and the growth rate of advanced economies and a set of emerging markets. As you can see, the correlation is unambiguously negative and especially strong for emerging markets. So why are emerging markets particularly vulnerable? In addition to the usual notion that emerging markets doesn't have an adequate policy framework and institutional environment that supports some of the cushions of dollar appreciation shock and global financial shock, we also want to mention that there's this usual sense of original sin associated with emerging markets. They cannot borrow in their own currency so that they have a direct exposure to dollar appreciation through their external balance sheets. But even after the financial crisis, we see countries starting to increasingly borrow in their own currencies. They're still subject to the whim of the international investors, because now the international investor starts to take on the currency risk as well as the usual duration risks and so on. So facing a reverse in global risk sentiment, the emerging markets are especially vulnerable to these capital flow reversals. This is called the original sin redux, characterized by Carstens and Shanes and others. So to understand more deeply the pervasive influence of the dollar, we use a local projection framework on a large data set spanning more than 20 years. And we basically want to understand the dynamic response of emerging markets, macro aggregate prices, and financial market activity in response to dollar appreciation. So the shock measure here we have is a broad nominal trade-weighted dollar index against a set of advanced economies. The reason we choose this as our shock measure is because we want to arrive at a component of the dollar appreciation that is as external to emerging markets as possible. Once we control for, first, emerging market real GDP dynamic factor to proxy for some feedback effect of emerging markets effect on dollar appreciation and depreciation as a group, as well as U.S. monetary policy and financial condition, those usual channels that affect emerging markets' economic fortunes independently. So here we are showing the impulse responses of emerging markets macro aggregates to 10% appreciation of advanced economy dollar index. So here, in terms of national accounts, you can see that the impact is unambiguously negative contractionary. In terms of numbers, you see that after 6 to 8 quarters, real GDP contracts by around 2% relative to a linear trend. In terms of specific components, you see that government spending declines as well as investment. And a lot of the action comes from contraction in investment. In terms of the prices, we also show that for emerging markets, dollar appreciation is deflationary overall. So as you can see from changes in the GDP deflator, as well as exports and import prices. For terms of trade, which is important from the perspective of emerging markets, we also see a worsening of terms of trade when there's an appreciation of the dollar. And finally, financial market activities typically contract after dollar appreciation, as you can see from here in terms of nominal credit and stock markets. Emerging market governments find it harder to borrow in dollar, as you can see from the EMBI spread. And with a concern about their own currency to largely offset the currency depreciation pressure, emerging market monetary authority typically hike their policy interest rate in response to dollar appreciation, which in itself is also a contractionary force. We mentioned a little bit about the weak, potentially inadequate policy frameworks and institutional environment that kind of shape the response of emerging markets to dollar appreciation. But we want to qualify this with a sense of state dependency. We show that appropriate policy regimes, such as flexible exchange rate regimes, as well as having an credible inflation targeting framework, as well as downsizing on some direct dollar exposure through their external balance sheet, could potentially help cushion the impact of dollar appreciation shocks. Here, as an illustration, we just plot the impulse responses, but separating between the blue line, which are the countries that largely peg their exchange rate or actively manage their exchange rate, versus countries that largely float their exchange rate. As you can see, for floaters, real GDP is typically insensitive to dollar appreciation shock. As a result, these countries don't find it worthwhile to raise their policy interest rate by as much as those peggers do. And we also find a distinct pattern in terms of responses for terms of trade and equity prices as well. I want to end this session by just acknowledging that this type of exercise is subject to the caveat that we cannot fully rule out the existence of selection bias, in the sense that there might be other institutional arrangements or linkages to the dollar that actually contributes to the insensitivity of countries to dollar appreciation shocks. But those countries, potentially, these institutional features could prompt them to self-select into taking on flexible exchange rate or inflation targeting. So, but we hope that this kind of evidence at least shows that for those countries that are more resilient to dollar appreciation shocks, these countries happen to equip themselves with some appropriate policy regimes. So I'm going to give the floor to Maury to talk about the rest of the paper.
Okay, thank you, Haonan. So if we think that the dollar's exchange rate is an important determinant of or predictor of what happens in EMs, it's important to ask what's driving the dollar. And I want to emphasize that in our methodology, the measure of the dollar exchange rate we use is the dollar's exchange rate against other advanced economies. That is, excluding emerging markets, because we want to try to minimize the feedback from emerging market events into the dollar and emphasize the events in global financial markets that are going to be driving the dollar and affecting emerging markets. So to do this, we use a very simple model. And rather than going into a lot of detail, I want to sort of give the spirit of what we're doing and how this has changed, like basically over the 50 years of flexible exchange rates. Very early on in thinking about exchange rates, economists like Rudy Dornbusch, Jacob Frenkel, realized that exchange rates, like stock prices, are asset prices, and the way you want to think about them is in an asset pricing framework. The initial attempts to do that basically were very monetarist in nature, in the sense that they assumed stable money demand functions and tried to explain exchange rates in terms of variables like money supplies. These proved inadequate for the same reasons that monetarism proved inadequate, just the spectacular evolution of financial markets. And you can see that evolution in looking at the pictures of global gross capital flows that Haonan put up, which indicate sort of the volume of financial transactions that are buffeting exchange rates, but also the variety of financial instruments and financial shocks that are traded and in which the foreign exchange market plays an intermediating role. So the attention in the recent literature on exchange rates, and this really parallels what has happened in the literature on monetary policy, has turned to focusing directly on what is the instrument of the central bank, the short-term interest rate, and how that propagates through the economy. And of course, in the recent period since the global financial crisis, there's also been a greater attention to quantitative easing and quantitative tightening as a determinant of exchange rates, and to longer-term interest rates, and stocks of debt as determinants of exchange rates. And there's been some very interesting recent work by Pierre Olivier and co-authors, by Robin Greenwood and co-authors on long-term debt and exchange rates, inspired by the QE experience. So where our basic framework starts out is with the first equation up there, which is a equation for the uncovered interest parity difference. So it's the difference between what you get investing in a foreign bond or investing in a U.S. bond, taking account the expected change in the dollar's exchange rate. And that we relate to three factors. Again, and this is going to very much echo this morning's discussion of quantitative tightening / easing, and also yesterday's discussion of how to think about the government budget constraint. But basically, we explain this by an excess return term, and I'll say more about each of these, a term reflecting the liquidity of the U.S. dollar, given its dominant position in global markets, and also the relative liquidity of the U.S. Treasury, not necessarily due to its dollar denomination, but due to its role as a global safe asset, as collateral in repo, et cetera. And that all of these terms should be thought of as, differences between the U.S. dollar and the foreign currency. The excess return term could be a risk premium in the sense of some sort of correlation between a stochastic discount factor and the exchange rate, and that's something we talked about both this morning and yesterday. But more modern theories think about it more broadly as, effectively the relative shadow price of some set of financial constraints which could arise from regulatory restrictions, such as the Basel III leverage ratio, from a value at risk constraint on portfolio behavior, or from some other means. The dollar liquidity factor was mentioned previously, and it just reflects the dollar's position in global markets. So we basically use this relationship iterated forward to derive an exchange rate equation through which we correlate the dollar's change with various factors. We look at changes in short-term interest rates. We look at changes in long-term interest rates. We investigate the role of the term premium. And we also look at proxies for these last two liquidity terms. Now, I don't want to spend a lot of time describing where these come from, but where we build is the recent very vibrant literature on deviations from covered interest parity. If you want to look at the best evidence of the importance of balance sheet constraints, think about covered interest parity. What is it? Well, I could invest in a dollar bond, or a dollar bank deposit, more exactly, or I could invest in a euro bank deposit and sell those proceeds in the forward market for dollars. So I've basically constructed two claims on future dollars, and those should cost exactly the same in a well-functioning market with perfect arbitrage. In fact, they don't. And the divergences have become very large since the global financial crisis. Now, partially this is due to financial restrictions, limited balance sheet capacity. Partially, and this has been emphasized in some very important work by Zhengyang, Hanno, and Arvind, it's partially due to the liquidity features of treasuries relative to other government bonds, insofar as they are denominated in dollars, but also have other attractive properties. I don't want to go into detail on various ways you could measure this covered interest differential, but we do use it as one of our correlates of the dollar. And I caution that not only does this affect the dollar, for example, through this liquidity value channel that has been emphasized in the work of Zhengyang et al. And also in Arvind's work with Annette. But in addition, there's a lot of evidence that shows that dollar appreciation, perhaps by tightening the budget constraints, or the balance sheet constraints of dollar debtors, makes portfolio capacity smaller. So there's two-way causation, and we don't want to ascribe causality in what we find. But what we do find is that the government bond yield differential, short-term and long-term, is really important for the dollar. The Treasury liquidity difference, which we measure in a particular way, is important for long-term dollar changes. What we call the basis, the covered interest parity differential, is quite important in the ways that Zhang and all have found. And as was mentioned by Hao-nan, the excess bond premium is really important quantitatively, and it's a very robust relationship. We can look directly at the effect of that in our local projection framework on emerging market outcomes, and we sort of try to calibrate this to the 10% appreciation shock of the dollar that Hao-nan looked at before. And what we see is that the effects of a rise in the excess bond premium are stronger, deeper than the sort of garden variety dollar shock. And this corresponds to some recent work that Simon Gilchrist and co-authors, who invented this measure, which is a very potent measure, potent predictor of U.S. recessions, have looked at in terms of the effect of this on sovereign spreads. The effects go much deeper.
More, you should wrap up.
Okay, let me wrap up with just some data to show where we are. I'm not going to talk much about implications of this for the future of the dollar, but just to say where this current phase of the dollar cycle is. As we all know, we had a pandemic, we had lockdowns, inflation came down as economies locked down. It's come up sharply, as you can see in the first picture on the left, as economies have risen. And as it has, the dollar has strengthened. And you can see the dollar cycle very clearly, how it spiked in the pandemic, as it often does in financial panics, came down, and is now coming back. Throughout the world, central banks are hiking interest rates. The green lines here show the moves in 2022, and we can expect this configuration to have a huge effect on emerging markets. I'll just end it there.
Thanks. First discussant is Sevim Kalimli Özkan.
Okay, can you hear me? All right. Okay, great. First, I would like to start by thanking the organizers for giving me the opportunity to discuss this paper. There's a lot in the paper, a lot of different topics combined very nicely, and some of them are dear to my heart, have been working for a long time on it. And I also would like to express my gratitude to Mori and Hunan for writing this paper. This is a great paper. It has everything you want in a BPEA paper. And I think it's also going to help us a lot, the ones who work on these topics in this literature, to advance, because it really brings everything together in a very nice way. And many of us are in this room, so if you don't agree with me, we can debate this. But let me start by why I think that, summarizing the three key takeaways from the paper and how it fits very nicely in this very broad, large, and complex and segmented literature, since everybody works on different parts of this literature. The first takeaway is the global dollar cycle. I'm going to call this GDC. correlates with global financial conditions, global risk sentiment, and US monetary policy. This, of course, is a close cousin to global financial cycle literature, started with Helen's Ray Jackson Hole paper in 2013 that argues that global financial cycle, GFC, which is defined as correlation of risky asset prices, leverage, and capital flows, globally correlates with risk sentiments and US monetary policy. Now, there is another strand within the global financial cycle literature that puts the dollar exchange rate at the center of global financial cycle. Early work by Bruno Shin and others argue that why dollar exchange rate is very important in this cycle is because of the large footprint of US dollar in global finance, and that's exactly why things in the data is not like our models. Financial channel of transmission is stronger than the trade channel known as the expenditure switching. We don't get all the good effects of expenditure switching. So this first part of the paper and result ties this work together nicely, making dollar central to these global movements. The second key result is this dollar appreciation being contractionary in emerging markets. I mean, it is bad news for emerging markets. Emerging markets currencies depreciate against the dollar, but also it can predict downturns. I really, really like this. I mean, again, this is a very old and large literature. This goes back to work by Krugman in 1980s, Andres Velasco's work. I mean, early empirical work on this by Mark Aguiar in early 2000, my work. So, I mean, it took some time for people to come to this because it is very hard to get data on these consistently across many emerging markets. But basically, depreciations are contraction in emerging markets. Again, supporting the financial channel being strongly. In the context of global financial cycle literature, we also know that, my Jackson Hole paper in 2019, others work on this, emerging markets are affected worse than advanced economies. So clearly, global financial cycle affects Canada and Mexico, but Mexico goes under and not Canada. And why is that? That is something important to understand. And again, the second part of the paper really talks about these issues in detail, brings together nicely these bits of literature. And the final part is about what do we do in terms of the open economy macro models, the new generation models. Clearly, exchange rate is an asset price. If we have an equilibrium exchange rate determination in these models, we need to bring in financial factors. And this links nicely to Mateo's work, Dimas and Oleg's recent work. The nice thing here is the authors talk about all different ways of doing this. You can have financial friction, segmented markets, like as in Mateo's work. You can have both, as in Oleg's work, or you can also go back to Tobin's work. I mean, risk-averse investors. This is what Ben Friedman was saying on the Zoom. If different assets have different risk-return properties, and policy affects that, an emerging market asset class is obviously going to be having different properties. So it is important then how do you model these things, and what is the data telling to us? Okay. So excellent paper that gives us a unifying framework over a large and complex literature. My comments is about there's a lot in the literature, and obviously on purpose I'm going to talk about some other things they didn't have a chance to talk about and kind of dig deeper on those things more in the paper. First, why emerging markets affected worse than advanced economies from GDC. We knew this from GFC, and now from GDC. They are affected worse, and I think it requires a little bit more investigation because it affects emerging market policies, right? If we put everything on US monetary policy, US bond markets, global investors, JP Morgan, then emerging markets, okay, great, there's nothing I can do about that. Is that the world we are in, or is there another world where there is some side also relevant for the emerging markets? That is going to bring me to my second point in terms of the UIP deviations. I mean, CIP deviation is very important. I fully agree. All that work is great. There shouldn't be any friction or deviation in that market. But I am going to show you that UIP deviation is actually critical when we think about emerging markets. And much more important, explaining this asymmetric transmission to emerging markets, and it's something that can inform emerging market policymakers. And why EPP? This is this new risk sentiment index they are proposing, excess bond premium, which is, I fully buy it. It works great in the data, but maybe do we have any theoretical justification, more granular data, why EPP is something that is going to work better than VIX, better than US monetary policy shocks or price shocks, things Sydney was talking about this morning. Okay, my emerging markets, got the short end of the stick here. Their answer is shallow financial markets, high FX debt, which leads to balance sheet vulnerability, and weak regulation and less credible macro monetary policies. I would argue that the first two of these are outcomes, that the evidence of something that is not right. And the third one is more deep down primitive. Of course, it is going to be very, very hard to separate these things in the data, but I'm going to argue that if we really try to understand UIP deviations in emerging markets, why they don't hold, why they are different, the dynamics from advanced economies, that can help us a lot in that path of separating outcomes from primitives and explain to a certain degree why emerging markets might be affected more from these dollar appreciation, their own currency depreciation, and other advanced economy countries' depreciation, and can deduce some policy lessons. Okay, so that's why it is important in terms of the emerging market policymakers. And if you talk to emerging market central bankers, they are going to tell you that they do look at UIP and not CIP. That is more important for the transmission. Recent optimal policy models for emerging markets, again, have this welfare maximization working completely closing the UIP wedge, and in that sense, how we create that wedge, why we have a UIP wedge at the first place. Is it about a certain friction? Is it about certain risk properties of that asset? Is going to be extremely important, linking that to policy. Okay, let me start illustrating this argument in a little bit detail. I'm going to show you here floating exchange rate countries' response. I don't want to get into the fixed pegs because there's something very hardwired in there, so I rather want to go to this, the risk pricing mechanism of global investors. So this is going to be floating emerging markets, floating advanced economies. What happens to their government's borrowing rates? This is going to be short term. Everything is going to be short term here. Emerging markets borrow short term. Everything is less than 2 years. It is harder to see 30-year bonds, 10-year bonds. So short-term government borrowing in emerging markets, that rate difference from the U.S. government borrowing when U.S. has this tightening. It's a surprise tightening. Here we use Gertler-Crady shocks, but you can go back to original row high-frequency surprises in Jonathan's work with REFED. You are going to get the same result, right? So emerging markets governments bond rates are going to increase more than 1 when there is surprise tightening in U.S. monetary policy, but advanced economies less than 1, exactly the opposite. This suggests investor pricing of emerging market risk is going to play an important role when we think about these questions, why emerging markets affected worse than advanced economies from global dollar cycle. This is, again, confirming what they showed, a little bit more detailed from my paper with Gita Gopinath and Pierre Deleo. What we do this year, again, use exogenous US tightening, which is depreciation for emerging markets, which is contractionary. As you see, growth goes down, capital flows out, inflation is mixed, but what is happening is the treasury rate, money market rate, all short-term borrowing lending rates increase because of this higher risk premium in spite of loosening monetary policy. Okay? So they are doing the right thing with the monetary policy, but still this risk premium channel is so strong that their external financing conditions get tighter. Now, how do we link this to whole thinking of UIP modeling? Because this picture means, of course, the UIP premium is going to be higher with that tightening of U.S. monetary policy, tighter global financial conditions. So how do we think this in terms of modeling and linking to facts? Authors are providing us a very, very useful framework to connect several models and the facts in the literature. And this literature is really, really segmented. And it's very simple to understand why it is segmented, because there are 2 ways of looking at it. You can look at from the US dollar side. You can look at from the Canada dollar side. You can look at from the Mexico peso side. I mean, there are 2 sides because there's an exchange rate and there's a UIP wedge. So, and the nice framework they provide, they say, like, look, if I write down the UIP condition, interest rate differential of a given country from the US, I minus IUS minus the exchange rate adjustment, that's an expected exchange rate adjustment. Of course, if you're a high interest rate differential country, your exchange rate expected to depreciate. That doesn't happen. That is not 0. So that's a wedge. And the way we think about this, and again, many people work on this, are in the room, Arvind, Hanno, Pierre-Olivier. There's a US dollar factor there. Okay, that's gamma dollars, convenience yield because of dollar, liquidity because of Treasury being a US Treasury, and there's this excess return. And that actually authors call dark matter. Why it is dark matter? Because this is going to be extremely hard to map that to the data. I mean, clearly that dark matter is going to have some global factor, call it raw US, and that can be about risk aversion of global financial intermediaries or some balance sheet friction on global financial intermediaries. I mean, this goes back to Hanno's early work. If we go to the risk aversion side with Adrian Verdelham, But then I'm going to argue that, again, if the goal is to understand this Mexico, Canada, Turkey, Switzerland difference, maybe Turkey is not a good example, but, a more sensible country, Chile or Brazil, Switzerland difference, I'm going to say that local side of the story is going to be very important. We think about global risk aversion, global intermediary friction, but also frictions coming from the countryside and these investors' differential risk sensitivity. So it is not that when these conditions tightens, JP Morgan drops, Mexico, Chile, Turkey, Argentina, all at the same time in a similar way, right? So there is going to be amazing heterogeneity across this. So you write the UIP condition like this. This is, again, author's framework, the US factors, and there's going to be risk aversion, frictions, everything here, and other things. Okay. Let me conclude with my last 2-3 slides. You take this to data. So it is a very useful framework to take it data. Plot the UIP monthly data, and you see that it never holds. This is in log. So line 0 means when UIP holds. It never holds in emerging markets. Advanced economies, it holds on average. There is a lot of fluctuations, volatility, and persistence. They are both correlated with VIX. So that is not different because VIX, of course, is a global factor. They are both correlated with VIX. What is interesting in these granular factors, when you regress UIP premium in emerging markets, how tight negative relationship with quantities, capital flows. There is no such relationship between advanced economy UIP or CIP and capital flows. But there is for emerging markets. When capital flows come in, UIP premium goes down. EPU is a measure of measuring credible policies, policy uncertainty. It's actually Steve's measure, economic policy uncertainty, with Nick Bloom and Scott Baker. We extended to emerging markets, doing a very similar exercise Sydney was talking about today for the QE, QT US to get at the risk perception specific to that country's policies. And then VIX is there. So what you see here, and all the other factors the authors talk about, VIX has a very important effect regardless, but also policy uncertainty. And when you use those together, the global risk sentiment and the local risk sentiment, you kill the quantity-price relationship, which shouldn't be there, again, in efficient financial markets. And using survey exchange rates or realized exchange rate doesn't matter. Let me skip that. My final point, excess bond premium. I think this is a very nice measure, works very nice in the data. How do we think about it? The author says it is capturing exogenous change in risk sentiments. I fully agree. And then I fully agree that dollar shocks against the G10 currency is not same as VIX and is not same as US monetary policy shocks. I mean, we call all these things shocks, but they are really not shocks, right? They are endogenous outcomes to an extent. But somehow we want to get at a picture like that, known as global financial cycle fact pictures. Right here, VIX correlates with corporate bond spreads, dollar, and UIP premia. So now I don't want to use VIX. I want to use gilt-rated excess bond premium, which will be fine. But I would like to understand the reasoning behind that. Is it about bond investors substituting US corporate bonds and emerging market sovereign bonds? It can be. I don't know. I mean, I have no evidence on this in the data. But what we know when we look at the sectoral shares of external debt in emerging markets, here by every sector, banks, emerging market banks in red, corporates blue, sovereigns green, when you look at the left-hand side is the loans, you see that banks and corporates are going to be borrowing in loans. The bond investors, US bond investors investing in emerging markets, but that will be sovereign. You see that almost 70% is going to be in emerging market bonds. So then how do I think about these substitution between the two? I think that's something important to work further. And an alternative to EBP can be earnings volatility, where the earnings of the US firms, if that is volatile, you can show in a model combining that type of uncertainty shock with financial frictions and to show all the things you want to show. With that type of a shock, corporate bond spreads in the US and foreign countries, Switzerland and Mexico increase, dollar appreciates against both countries' currencies, capital flows out, and UIP premium goes out. So in that sense, I think it is important to go back, this sense of how do we combine kind of early literature, James Tobin, and so forth. There's a early BPEA paper by Curie in terms of risk-averse investors where this varies for an emerging market assets versus advanced economy assets versus what type of balance sheet friction is there on JP Morgan's balance sheet. I think that's going to be important to sort out and match to the data in this literature. Very valuable paper providing a unifying framework on how to think GDC, global dollar cycle, different than GFC, and its detrimental effects, especially in emerging markets. The bad effects are on emerging markets. And there's a very key policy implication in this paper. the case for flexible exchange rate is stronger. I think this is very important, because if most detrimental effects goes from high risk premia, as I showed you, then flexible rate is a good thing for emerging markets, because they are going to absorb some of this risk premia. And you showed those pictures, you saw those pictures when authors showed you what is going on with the policy in emerging markets. The pegs increase the policy rate, right? The floats don't do that. So that means if you're a floating country, you can deal better with this contractionary effect of the global dollar cycle. Thank you.
Okay, thanks. The second discussant is Matteo Maggiore. And we're online for this one.
It tells me that I cannot start the video, so you might want to change the settings for that. But I can certainly at least share the slides. And hopefully now you also see me and hear me?
Yes.
Fantastic. So thank you for having me, albeit virtually, at this conference. It's a pleasure to discuss Maurice and Hanan's work on the global dollar cycle. And I'll try to keep it brief, because I think we're sort of running over time, if I understand correctly. The paper, it's really about linking the nominal dollar effective exchange rate to global financial conditions. And for this, there was a fair amount of evidence before this paper, which essentially I'm going to reduce to the idea that when there are financial panics, there's a dollar funding squeeze, and the dollar tends to appreciate. So risk premia go up, and then the dollar depreciates as we emerge from that panic, and that creates a fair amount of movement. The paper takes another turn and so it tries to link this with real performance or GDP growth, particularly in emerging economies, in the aftermath of these dollar appreciations, and provide some evidence that when the dollar is strong, this spells bad times coming in the next few years for emerging markets, and then discusses policies to smooth this dollar cycle. My discussion is largely going to focus on what do we know about the importance of markets in setting exchange rates, and in particular the role of the dollar, and then thinking a little bit about new and old policy tools that are being suggested to smooth this cycle, which hopefully will make for a good segue to the group discussion. I think Hanan showed a version of these pictures, which I did take from their paper, for current accounts. Here I'm actually looking instead at the position. So the blue lines are assets that each country owns in the rest of the world. The red lines are assets that the rest of the world owns in that country, summed up for all countries. So this picture is familiar to most of you, but if you haven't seen it, it's quite striking. It shows us, in some sense, the financial globalization that has gone on for the last 30 years or so globally. And you can see that there's been an explosion of assets that we own all around the world. And there's been a lot of work in the last 10, 15 years digging into the currency composition of these assets. So are the assets and the liabilities matching, or are they taking a lot of risk in the middle? And I would say that the evidence is that there's a lot of heterogeneity in exactly the composition of the assets and liabilities. But one very common factor across the globe is that the dollar is a big component of both the assets and liabilities of each country, even for positions that don't involve the US. So if you think of like Europe investing in Brazil, the dollar is going to have a role in that, despite the fact that the US is not directly involved. So these are very large portfolios. And, Maury gave a 2-minute, but like, a master of the field review saying, look, when we started thinking about exchange rates, we tried to look at fairly narrow aggregates for portfolio balance or for the monetarist approach, and that really didn't work. And recently there's been much more interest in this, and I think part of that comes from these pictures. We kind of come to realize that these positions have gone very big. These are very large portfolios, and that shift in these portfolios are probably creating large imbalances in the demand and supply of currencies and moving exchange rates around. And so that's sort of, roughly speaking, where some of the modern literature on exchange rate determination is. If you think about who absorbs the risk of a shift in these portfolios, well, it's some financial institutions. It's not households directly. It's not the long-term issuer of the assets in the short run. And they're going to demand some risk, some sort of risk compensation. They're going to make some money out of this. And this is a force that helps pin down exchange rates. And the dollar is quite central to this story. Why? Because, well, it's, as I mentioned, both big in terms of global capital flows, even when the US is not involved. but it's also the main market in which financial institutions tend to fund themselves. So you can think that a stress in the dollar market by increasing the funding costs makes these intermediaries less likely to want to intermediate risks. So they're going to ask for bigger compensation for whatever the world markets are asking them to intermediate. And so the paper sort of embraces this financial determination view of exchange rates, and it stresses really the dollar centrality of this. And there's still much that we don't know about this view. If I take sort of this view of the world and try to characterize a little bit how this has helped evolve policy views, and of course I'm going to largely caricature the policy views. But the older stance, the Washington consensus, was no capital controls, no foreign exchange intervention. These things are off limits. If there are problems, there's a bunch of ex post interventions like an IMF bailout. And there was a view that devaluation was probably expansionary, largely through the goods market. So if I depreciate my currency, my goods become more attractive to the rest of the world. That helps me export more, and that helps me dig out, for example, of a recession or a bad shock. Post 2007, 2008 financial crisis, there's been a big rethink of macro policy frameworks in general, but in the confines of international macro, I think it's useful, again, to caricature a little bit the IMF policy stance and how it has evolved. So they first moved under, when Blanchard was at the IMF, they moved on capital controls. So they recognized that ex-ante capital controls as a prudential measure might have an interesting role to play to smooth these waves of capital that Mori and Hanan have been mentioning, that enter and exit emerging markets and make it very hard to control the economy. More recently, particularly under Mori and then under Gita, the IMF has also moved a little bit farther on FX intervention, saying, again, as a tool for smoothing these cycles and managing, for example, the exchange rate, it can have a role. And I think Pierre Olivier, I believe is in the room at the IMF now, might have his own views and leave his own mark on this. There's been also a strong recognition of the centrality of the dollar on the financial side and the centrality of the dollar on the good side in terms of like dominant currency pricing, like Gita has put forward. So if you look at their modern, the most recent version of their policy framework, which is the integrated policy framework that Gita has worked on, it has really incorporated a lot of these frictions and a lot of these tools to smooth these waves of capital that are moving around the world. And it's taking a view that devaluation might or might not be expansionary. In fact, in some cases, it might be contractionary. It depends on what exactly are you borrowing in, which currency are you borrowing in, which currency are you pricing your imports and exports in, and is it sticky? And so there's a much more nuanced view that has really come out of this, that this paper sort of contributes to. Now, my questions to the authors as academics are, one, to define a little bit beyond sort of funny names or acronyms like the global dollar cycle, the global financial cycle, what it is that we're actually looking at. In particular, I mean, we know that asset markets tend to be very correlated around the world. That risk premia do tend to have a big common component and move around, and that the dollar is a safe currency. This has been understood for a while. So to what extent is the dollar cycle just a really useful way to consolidate these facts and sort of give it a single term? Or is it an independent phenomenon? I think that's something that at some point we're going to have to start disentangling more in the literature. We're not there yet. Similarly, I find that the relationship with future economic growth, it's always the trickiest one to assess. Like, what exactly are the channels? Are we sure that the dollar is causing this, or it's a byproduct? With time series or aggregate analysis, there's only so much that we're really confident in saying. So I think the micro data and working more carefully through specific episodes are really going to end up sort of pinning this down. But I do think the consensus has moved away from it's surely a depreciation is expansionary to surely we don't know, and there's probably a lot of different cases that we need to think through. My questions to them as policymakers is, a lot of these new concepts had to be evaluated empirically, and there is actually little hard evidence on policies like FXI or capital controls. And I don't mean this negatively. A lot of my theoretical work on segmented markets and frictions in the financial determination view of the exchange rate has sort of resurrected the literature on FX intervention, which was largely thought to be ineffective and in modern models tends to have an effect and can be used. But there's a difference between resurfacing it as a conjecture or sort of clearing out what you need to believe for that policy to be effective versus how much actual high quality evidence do we have for it, or similarly for capital controls. My sense is so far we have relatively little. Yet, the policy consensus is moving on this and countries are implementing these policies. And there's a reasonable concern that tools that we introduce to mitigate the dollar cycle are going to be prone to abuse, especially capital controls, given that they have fiscal motives to do them, because the revenues are guaranteed to be positive, at least for the government side, not for the whole economy. FXI is a little bit more risky because the government can lose money on it. So the fiscal incentives are probably not as bad if you want to abuse the policy. So I'm curious to hear in the discussion that follows this, Maury's views and the audience views on how much should countries smooth this cycle, which are the appropriate tools. We talked a little bit about nominal exchange rate flexibility, but that one comes with its own problems. The exchange rate, once you take a modern view of exchange rate determination, it's both a shock absorber, but can be the source of shocks being propagated to that economy. So that can't be quite the full response. Let me stop here. I think this is a really useful piece of work on the importance of the dollar. It brings together a number of things from both policy and academia. And I think I'm with Sebnem that it's a perfect Brookings paper in that sense. I think it does provide some new evidence, which I found quite compelling. There's a lot that remains to be done in this space, both on the theory and on the data. And it's an important space because it's affecting policy in real time, particularly in emerging economies. And that's the welfare of a large part of the world population, and we should try to have better answers. Thank you.
Okay, thanks. Thanks. That was great. Questions from the floor. Okay, so I see Pierre.
Yes, thank you. So I think this is a very nice and a very important paper, and I think it's great to have it on the panel. I want to take the authors a little bit to task, given that we are, as they point out, we are in the middle, or maybe towards the end, or we don't quite know, of a very sharp dollar appreciation, especially a sharp dollar appreciation against other advanced economies' currencies. Now, this is something that at the fund we've been flagging for a while as a very large downside risk. We know from the body of work that has been cited by the authors, previous work that's been done by others, including Sebnem here and others in the room and elsewhere, that every time there is this sort of sharp tightening of financial conditions, which tends to be associated with the dollar appreciation, it spells trouble for emerging market and developing economies. Now, in the past, I think there's a sense that it spells trouble, the trouble is kind of front-loaded. So if I think about the early 1980s disinflation episode, the Volcker disinflation, or sort of disinflation in other parts of the world, this is associated with the Latin American debt crisis of the early 1980s, the sort of sharp rise in interest rates, almost immediately created trouble in a number of emerging and borrowing economies. In the 2013 taper tantrum, for instance, trouble came even before the tightening happened. It's just a mere announcement that there could be a tightening at some point down the road already sort of tightened conditions and created much more adverse financial conditions on emerging markets. So in a sense, there's a little bit of a puzzle in the current environment. And the puzzle in the current environment is we've seen the very sharp dollar appreciation. We've seen the tightening of financial conditions, but so far, maybe that's the shoe that is left to drop, but we haven't seen a major dislocation of happening in emerging markets, and there's been some increasing in the spreads. There's been, of course, economic conditions are not exactly great, but there hasn't been a major crisis. And so we've been sort of scratching our heads and trying to understand, as you can imagine, at the fund, we've been trying to spend quite a bit of time on this. So is this time different? We're always a little bit concerned whenever someone says, is this time different? So I sort of want to turn it to the authors. The authors are sort of saying, well, this could spell trouble. We haven't seen the trouble yet. Could it be that there are just delays, or could it be that we've had improvements, for instance, in the ways emerging market economies have been dealing with this tightening cycle? We know, for instance, a number of them have tightened monetary policy ahead of advanced economies. That's especially true in Latin American countries. They haven't had as much depreciation of their local currency against the dollar as the advanced economies' currencies have. There's been less depreciation. If you think about a country like Brazil, for instance, there's almost no depreciation. So I'm sort of curious, when we look forward from this body of work that documents the vulnerability of emerging market economies to the dollar appreciation, you know, in a sense, why is it that we haven't seen more, and is more coming? Thank you.
Zhenyang Zheng.
Thank you. First, I want to echo Shevlin and say this is really a nice synthesis of many strands of literature. In particular, I find this a good big picture so we can all take a stand back and think about the entire issue at this critical juncture. I have one question and one comment. Here's my question. So if I understand correctly, the currency access return is a key concept in your modeling because you iterate this forward to determine the level of exchange rate. So when you model the currency access returns, especially for EM, you have a risk premium term, which includes currency risk premium and term risk premium. You have a liquidity premium term, but I'm wondering if there's a missing default term that encompasses especially the sovereign and the corporate sector default, which could show up in the access returns. I'm wondering how you think about that, if that has an effect on the currency return and level dynamics. And here's my comment. One thing I really like in your presentation is to distinguish the Treasury liquidity premium versus the general dollar liquidity premium. So first, we can think that the Treasury is somewhat special against other assets, and then there's some more general liquidity premium assigned to dollar debt assets or even non-debt assets. But one thing I want to bring up is that before the financial crisis, we find that the Treasury premium is really special. In particular, the Treasury basis was very wide, whereas the LIBOR basis was pretty much close to zero, aside from some small episodes. But after the GFC, things completely reversed. The Treasury and the LIBOR CIP strongly co-moved, and they have some interesting patterns in relation to exchange rates and business cycles. So I would encourage you to think about this both before and after the financial crisis, and think about that, how that fits into your framework. Thank you.
Arvind Krishnamurthy.
First, just a quick reaction to Pierre-Louis, your comment. I'm sure you know this, but I was told that India is burning through their foreign exchange reserves faster than they have in the past, and that seems important in thinking about when we get to the end. I just comment on the paper. So I read this paper as putting a bunch of stuff together that we have learned over the last 15 years. This is what Shebnem and Matteo pointed out. And to me, the things that I take away as being particularly important is this very strong spillovers that you see in the world, the global financial cycle, the global dollar cycle. There are very strong spillovers, and they really are a challenge to our traditional international macro models, which basically, to caricature, say, if you have a floating exchange rate, you shouldn't see spillovers. So something is very different in the way we should be thinking about how to model the world. And the second point, which is the importance of the dollar, which shows up in a bunch of ways, both in quantities as well as in these asset price reactions. And the regressions that Maury was showing us, which were connecting movements in the dollar to things about portfolio flows, and in particular, movements in portfolio flows that are about the value of safe assets or liquidity in the US dollar market seem important, and also point to types of factors that really matter in what drives the cycle together and what puts the dollar at the center. Okay, so those are just two observations of what I view as very important outcomes of this research. And then I have a comment or question, and this ties back to yesterday's discussion, which is I'm going to kind of expand on this point that it's about safety and of treasuries, to think about the world as a current world in which effectively treasuries or safe dollar assets are like world gold, which then raises another concern, maybe related to Pierre-Olivier's concern, and related to the paper that Hanno presented yesterday. If we imagine that world in which, treasuries lose value substantially and are no longer liquid and safe, that seems like it's sort of like imagining a world in which the gold of the world just disappears, half of it disappears, or where will we transit to? This also seems like an important challenge for policy sitting at this juncture.
Jason Furman.
So first I want to say the test of a theory is it's out of sample predictions, and currently 20% of BPEA is at the National Gallery. So my second point is possibly more relevant, is I can now see foreign central bankers coming into the Fed saying, see this thing we've been complaining about forever, it's really well documented, it's really true, it's really bad. Is there anything in this paper that should make the Fed care any more about them thinking that than they cared before?
Jean-Marie Melesi-Ferretti.
Would echo the praise. I think it's a fantastic paper and very exciting discussions too. I wanted to ask the authors push them a bit on their view on the current appreciation episode. I see three factors at play. And the first is, of course, U.S. excess demand, if you want, inflationary pressures in the U.S. interest rates rising. But since you're looking at exchange rate of the dollar vis-a-vis other advanced economies, you have a massive negative shock to Europe this time. So taken from that angle, it may be something that is, if you want, less threatening to emerging markets as being more local, the move of the dollar maybe more due to basically war in Europe and the dramatic terms of trade shock that segmented energy markets have caused in Europe. And I think the third is the increasing global risk aversion, and that's where the emerging markets are more at risk. And I wonder how it's a configuration that hasn't happened simultaneously in a while, and how do you think about how these play out for emerging economies? Thank you.
Hanno Lustig.
A really interesting paper. I wanted to see if I could tie together the discussion yesterday and what we talked about today. So the U.S. enjoys this exorbitant privilege, earns large convenience yields on treasuries because it's effectively the world's safe asset supplier, has a monopoly there. But that incentivizes foreign issuers to try and capture a little bit of that convenience yield by also borrowing in dollars. And of course, in times like this, when there's financial volatility and the convenience yield on dollar-denominated assets goes up, as your work points out, the dollar then appreciates. And that, of course, is a problem for these foreigners who were trying to borrow cheaply because now the cost of servicing the debt goes up quite dramatically. And so then the question, and I guess that's what Jason was referring to, is does that exorbitant privilege come with a little bit of responsibility for policymakers here? That is to say, if you have very expansionary monetary policy and then all of a sudden you step on the brakes very abruptly, that causes potentially a lot of pain for these foreigners who, because of the way our international financial system works, we're really incentivized to capture a little bit of that seigniorage revenue that we benefit from and that has greatly increased the fiscal capacity of the U.S. So I guess my question is, does the exorbitant privilege come with a little bit of responsibility as well to think about the rest of the world. And then I'll add that I also think as a result of this, that it's in a way unfortunate that our profession is so US-centric, because we always use the US, especially when we think about macro, as a benchmark, but it's not a very good benchmark, because most countries can't even think about doing what the US does when it comes to fiscal policy, I think. And it's good to remind ourselves of that. Yes, thank you.
Authors.
Okay, let me thank the discussants and the participants, and also apologize for going over my time. So I'll try to be a little bit briefer now, and not take up every point that's been made. Some of them are touched on in the paper, and they raise issues that would take longer to discuss than we have, even if we were going till 5 p.m. One key point that I think relates to both what Shebnem said and what Matteo suggested we need to look at is the the sort of endogeneity of policy regimes and the endogeneity of policies. We would like to know, if capital controls help or hurt, if intervention helps or hurt. And part of the problem with that is that the triggering of these policy actions is always in response to events, and so it becomes very hard to do controlled experiments. Similarly, Shebnem mentioned primitives and how those affect the outcomes of regimes. This is actually something that Jan mentioned in her comments on the paper initially. When we look at these regimes, are we just saying that there are countries with good institutions and bad institutions? So I was put in mind of the political scientist Ian Bremmer defines an emerging market as a country for which, quote, politics matters at least as much as economics to the markets. So I think that kind of says it all. Maybe by that metric, the UK and even the US are becoming emerging markets. But this is sort of the nub of a lot of our difficulty in trying to figure out how policies affect growth, how they affect cycles, and all the rest. Let me inject a couple of clarifications, because I think some audience members may be confused. So when Shebnem talked about uncovered interest parity, she was mainly referring to uncovered interest parity between the dollar and an emerging market currency. And that's something that's really important. It's really key for understanding the mechanics of why our local projections show what they do in terms of responses. And so I'm certainly not downplaying that. It's not something we go into in the paper, because our UIP condition is really about the dollar versus other advanced economies. And similarly, Zhengyan's comment about default risk, it would really be more of an issue in Shebnem's context than it is in ours. There's a very important question that Pierre-Olivier and Jean-Marie touched on about, we're sort of waiting for the shoe to drop, but the shoe hasn't dropped yet. And why is that? I think Jean-Marie identified some factors. Pierre-Olivier also, that if you look at emerging markets, they have generally been much more proactive in raising interest rates than have the advanced economies. Our chart sort of shows how much Brazil, for example, hiked last year, and it's hiked even more this year, without which I think the political environment in Brazil would be make for a much tougher relationship with international markets than we're seeing. The dollar appreciation has actually been not that great compared to other episodes. It's about, like 13% since the middle of 2021. That's significant. But if you look at how much the dollar appreciated from the middle of 2014, when it became evident that the Fed would be the first to lift off in the world from the ZLB, didn't happen for a while, to the end of that cycle, it's much greater, and that created a lot of turmoil in China, in other emerging markets, and what has been referred to as a mini recession in the world economy through the middle of 2016. So, you know, what we've seen so far is not really that impressive, and I suspect that the U.S. has a way to go in terms of interest rate hikes. The labor market hasn't slowed. The housing market has slowed a little bit. High-yield spreads haven't risen a lot. If you look at the Gilchrist-Sarachek excess bond premium, it's at a pretty low level. So those shoes haven't dropped yet. And the question is, when they do drop, which I think they will have to if the Fed is going to meaningfully reduce inflation, we may well see more turmoil. Arvind raised a really fascinating question. We touched on it very briefly in the last section about the dollar's global role and how confident can we be in that global role. And you know, again, that would take us very far afield. Should the Fed care about emerging markets? I would argue that in past episodes they have. You know, after the Fed's initial liftoff hike in December 2015, the Fed waited a full year before another hike, and a large part of the motivation was what was happening in terms of China, emerging market turmoil, and how that was feeding through to the rest of the world. Yeah, I'll just stop there.
Thanks a lot, Maury, and thanks a lot for the comments and suggestions. So I just want to briefly add 2 points. The first point is related to Maury's discussion about the current scenario, and this kind of reminds me of an early paper by Guillermo Calvo in the 1980s that tells us sometimes it's not that the absolute level of the dollar exchange rate that matters. What matters is the rate of depreciation. And the second point I want to add is Matteo raises a very important point about causally identifying the impact of the dollar, especially on the real side of the economy. And so there are a number of papers, but not a lot of them, that talks about this. Like the paper by a lot of Fed researchers that talk about how dollar appreciation could causally increase the borrowing costs of syndicated loans, and so on and so forth. But I think this is an especially important avenues of future research that we might want to consider.
Okay, thank you very much, and thanks for all of the speakers and all the discussants, and for all of you for participating in person. Once again, we are thrilled to have done this in person. We look forward to doing it again in March and seeing you here then.